So hello all my dearest students, I hope you all are doing good. So today we are going to start with our revision of another very important topic, and that is capital gains. Okay. So in capital gains we have to do discussions from section 45 to section 55, and we are going to do the discussion in full English, 100% English. Okay. So the very first thing that we need to see is that in every head of income, the first section is always a charging section. Capital gain chapter is quite different as compared to other chapters. In capital gains, there are multiple charging sections. Like in PGBP also, there were multiple charging sections. One was general charge section 28(1), and then there were certain small special charging section. But in capital gains, there are a lot of big special charging sections. Okay. So your majority of the time will go in discussing the charging section itself. Let us start with the general charging section first of all today. The general charging section, which is covered in section 45(1), which says that you need to transfer a capital asset and earn profits and gains. Then your profits and gains shall be chargeable in the previous year in which the transfer took place. Okay. So we have to do these four things. Once we do these four things, then we are liable for capital gains as per section 45(1). Okay. Now, we need to understand the meaning of each and every term one by one. First of all, what do I mean by the term capital gains? Capital asset, sorry. Then we will see what do you mean by the term transfer. Then we'll see what do you mean by the term profits and gains. Then we'll see what do you mean by the term chargeable in the year in which transfer took place. So all 4 points we need to analyze one by one. The very first thing that we need to understand over here is what do we mean by the term capital asset? Now listen, the term capital asset is defined in section 2 clause 14. How it is defined? It is defined into 2 parts. It is defined in means part and exclusive part. Capital asset means few things. Capital assets does not include some things. What does it mean? It means point number A. It means property of any kind which is held by you. Any property which is held by you, movable, immovable, tangible, intangible, related to business, personal property, it doesn't matter. Every kind of property is your capital asset as per point number A. What is point number B? Any securities which is held by foreign institutional investors. If an FII is holding any security, remember that will never be treated like a stock in trade. That will always be treated like what? Like a capital asset, so that they get the advantage of what? The capital gains provisions under the income tax law. Okay, like 111A, 112A, so on and so forth. The third one is we are going to deal that later on when we will do the discussion of section 1010D. At that point of time, we will do the discussion of that. Okay. The next one is what does capital asset does not include? Capital asset does not include stock in trade, because it is already covered in PGBP. It does not include personal plus movable items. Personal plus movable items. But in personal and movable items, there are few items which are definitely called as capital asset, like jewelry. Even though it is personal movable, it is a capital asset. Archaeological collection, drawing, painting, sculptures, any other work of art. These assets are always capital asset, irrespective of whether they are personal and movable. Apart from this, rest of the personal and movable assets will not be considered to be a capital asset. Next, rural agricultural land in India. The land has to be rural, the land has to be agricultural, and the land has to be in India. Sir, what do you mean by rural area? A rural area means an area whose population is less than 10,000 people as per the last census. It means if the population is 10,000 or more, it becomes an urban area. And once it becomes an urban area, always remember, up to 2 kilometers area will also be considered urban if the population is between 10,000 to 1 lakh. And up to 6 kilometers will also be called as urban if the population is more than 1 lakh and up to 10 lakh. And up to say 8 kilometer area will also be called as urban if the population is what? More than 10 lakh people as per the last census. Okay. And last but not least, there are certain gold deposits, bonds which are excluded from the definition of capital asset, and deposit certificate under the gold monetization scheme, that is also excluded from capital asset, and interest on that gold deposit, gold monetization scheme, the deposit which you get under the gold monetization scheme, the interest on that is also exempt under section 1015. So you don't have to pay tax on interest also under IFOS. That is also exempt. Now there are certain small issues that we need to address over here. First of all, are silver utensils capital asset? The High Court has said that silver utensils are not capital assets. They are for personal purpose. They are not capital assets. Then what about the gold bars, souvenirs, etc., which you use for puja, etc., for deities, for Bhagwan? Are those capital asset? The court has said that yes, they are capital asset. When you sell them, you have to pay capital gains on that. Okay. What about gold utensils? Are gold utensils capital assets? Yes, gold utensils are capital assets. Silver utensils are not capital asset. Be very careful. Now coming to the main charging section once again. Capital gains, if you want to charge, there has to be profits and gains. What do I mean by the term profits and gains as per section 45(1)? If you want to cover profits and gains under 45(1), then your profits and gains are supposed to be real gain, real gain, real gain. It should not be notional gains. Notional gain cannot be charged under 45(1). For notional gains, you have to make a separate charging section like 45(2), etc., etc., etc. There are many charging sections where you are charging notional gains because they are not getting covered under 45(1). Okay. Now coming to the next part of the charging section, that is transfer. What do you mean by the term transfer? I don't know the meaning of transfer. The government has given an inclusive list of transfer. The government has not given the meaning of the word transfer. Sir, what does it include then? Transfer includes C. Transfer includes sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of a capital asset into stock in trade. All these are transfer. Then, in case of immovable property, the date of possession is considered to be the date of transfer. The date on which you give possession, that date will be considered as date of transfer as for the purpose of immovable property. And in case of immovable property, if you stay especially in a society where the society is the owner of your property, then the property is not transferred, the ownership is not transferred, the right to enjoyment is transferred by the owner. That is also called as what? That is also called as a transfer. And last but not least, maturity or redemption of zero coupon bond is also transfer. Okay. So whether exchange amount to transfer, definitely exchange amount to transfer. There was one company by the name called as Orient Trading Company, where shares of one company were exchanged for shares of another company. That was taxable as transfer. Therefore, it was chargeable under PGBP. Why it was charged under PGBP? Because Orient Trading Company was a trader in shares. That is the reason it was charged in PGBP. If the SSC was not trader in share, then it would have been charged in capital gains also. Okay. Now, suppose if I buy a land 20 years back and after that last year I made a building on that land. 20 years back I bought a land and last year I made a building, and on that building, after that making that building, in next few months I am selling that building along with the land. How will the capital gains be computed? You have to make two computation. For land you have to say long-term capital gains, and for building you have to say short-term capital gains. You have to make two separate computation. Okay. Now after the charging section is done, now we are going to talk about the computation mechanism of capital gains. There are two sections of computation for capital gains. One is Section 48, another is Section 50. What is Section 48, sir? Section 48 talks about other than block, which is not covered in block of asset, which is not depreciable asset. And Section 50 talks about block of asset. We are not going to talk about block of asset as of now. We are now interested in other than block mechanism. First of all, block we will do discussion later on at the end of the chapter. So other than block, what has to be done over here? How the capital gains? A very simple format, full value of consideration. After that, you have to expense has to be reduced. Then cost of acquisition, index cost of acquisition, cost of improvement, index cost of improvement, and there is one more item which is to be reduced, which we will see in next 10 minutes. Okay. Now, there is one very important amendment which has come in Finance Act 2023. Therefore, you have to keep this thing in mind. It will come in the exam. Definitely, it will come in the exam, and which says that if you bought any property on which you have already claimed deduction of interest under section 24 or under chapter 6A. Suppose if I bought a property on loan, and on that loan I'm already paying some interest and I'm claiming the deduction also under section 24 or under chapter 6A, then that interest cost shall not form part of what? Form part of what? Cost of acquisition. Okay. So that there is a reduction in dual deduction. Otherwise, people used to take dual deduction of interest cost. Okay. Now, coming to some provisos which are below section 48. Very, very, very important proviso. The first one is section 48, first proviso. The first proviso is applicable to whom? Listen carefully, all of you see here. It is applicable to non-resident and foreign companies who purchase shares or debentures or bonds of Indian company. How they purchase? They purchase in foreign currency. So if a foreign company, non-resident or foreign company purchase shares, debentures or bonds of Indian company in foreign currency, then their calculation will be done as per 115A rule. Rule 115A will say that how the capital gains has to be computed. Now this proviso is applicable for shares, debentures purchased in foreign currency only, not in Indian currency. Further, it is also applicable if it is a case of reinvestment. You purchased once, then you sold, then you again reinvested, then also it is applicable. Secondly, this section is applicable, this proviso is applicable to government company also. But this is not applicable to government bonds, RBI bond, state government bond, central government bond. This is not applicable to them. This is not applicable to units of UTI, mutual fund and business trust. Yes, this is applicable to listed as well as unlisted shares, both. But this is not applicable to shares which are covered in 112A. Always remember, this is a very important point. Shares which are covered in 112A will not be subject to first proviso to 48. You are not going to follow first proviso to 48 for 112 shares. Okay. Then this is applicable. This proviso is mandatory if you fulfill the conditions. Okay. And once you fulfill the condition, this proviso is mandatory. You will not get the benefit of indexation. That is second proviso under the income tax law. Benefit of indexation is not there. So what happens in this particular proviso? How the capital gains is computed? Remember, you have to first convert your sale consideration and expense on transfer, both of them as per average of TTBR and TTSR on the date of transfer. For sale consideration and for expense on transfer, the rate is same. Average of TTBR and TTSR on the date of transfer. For cost of acquisition, you have to take average of TTBR and TTSR on the date of purchase. And then once you do this, you will get a capital gains in foreign currency, in dollars, in pounds. Then you have to reconvert that into INR, because in India you are going to pay taxes in INR only. So how will you reconvert that into INR? You have to reconvert as per only TTBR. Now don't take average, okay? Only TTBR on the date of transfer, okay? Then coming to the next proviso, that is, what is the indexation of the current year? The indexation of the current year is 348, and the indexation of the preceding year will be given in the examination to all of you. Don't worry about it. Okay. Now, indexation is applied to every kind of asset except few assets. Like I have told you, like first proviso to 48, indexation is not available. Similarly, indexation is not available in case of bonds and debentures. But there are two special kind of bonds which are eligible for indexation. One is known as capital index bonds. One is known as sovereign gold bonds. These are two special kind of bonds on which you get the indexation. Okay. Apart from this, you don't get indexation on any other bonds and debentures. Apart from that, UTI mutual fund, you can claim indexation. Then business trust units, you can claim indexation. But other than 112A assets, you are not going to get indexation. I hope you all remember that. Okay. Next. The benefit of STT is not available under capital gains. It means when you purchase shares, you will not add STT to the cost of asset. When you sell shares, you will not reduce STT from the sale consideration. Yes, STT will be allowed as a deduction under PGBP if you are a trader in security. Okay, if you are a trader in security, you can claim that as a deduction. But here you are not going to get the deduction of STT. Okay. Now the fifth proviso I am going to talk about later on along with section 47 and section 10. Now coming to when an asset will become short term. Yes, it is defined in great detail when an asset will become short term, but it is not defined in great detail when an asset will become long term. Okay, it is very simple. If an asset is not short term, then it will become long term. Short term capital asset means what? Which is defined in section 242A. Sir, what do I mean by the term short term? Short term means any asset from the date of purchase till the date of sale, 1 day prior to that, 1 day prior to that, 1 day prior to date of sale. If that period is from date of purchase to 1 day prior to the date of sale, if that period is up to 36 months, then it is short term. Otherwise, it is long term. But there are certain assets which become long term immediately after 12 months. Which are those assets? First of all, listed shares, equity and preference. Both of them will become long term after 12 months. Next, listed securities like bonds, debentures after 12 months. Units of UTI and equity oriented mutual fund, you listed or unlisted, now both of them will become long term after 12 months. Zero coupon bond, listed or unlisted, both of them will become long term after 12 months. And there are certain assets will become long term after 24 months. And that is unlisted shares and immobile property, that is land and building. Those will become long term after how many months? After 24 months. Okay. Now coming to some very important issues of cost of acquisition. B.C. Srinivasa Shetty, very landmark judgment which came in 1981. What happened in this case? The SSC has sold some goodwill. The SSC has sold the business, and in the process of selling the business, the SSC also sold some self-generated goodwill. Self-generated goodwill of business was sold by the SSC. The department sent a notice that for sale of goodwill, self-generated goodwill, you have to pay capital gain tax. The sale consideration was XYZ amount and the cost of acquisition was taken as nil by the department. The SSC raised the question, how the hell you can take the sale consideration as nil? Cost of acquisition as nil, sorry. Where it is written that the cost is nil? Where it is written in section 55 that the cost of acquisition of a self-generated goodwill is nil? At that point of time in 1981, it was not written, unfortunately. Therefore, the department said that it should be not applicable instead of what? Instead of nil. Therefore, the word nil is also a number under the income tax law. And zero is also a number. It has to be mentioned in the law. Then only you can write down over there. You cannot write zero by default yourself. Therefore, the court said that it is not nil. It is not applicable, and therefore your computation mechanism fails. And if your computation mechanism fails, then you cannot apply the charging section on the assessee to apply tax. Okay, and therefore with that note, over the period of time, the government made multiple amendments under the definition of cost of acquisition under section 55. Remember, there are two sections for cost of acquisition. One is section 55, another is section 49. Right now we are talking about section 55. Later we are also going to talk about section 49 also. Don't worry. Now section 55 says what? If you have goodwill of a business or profession, or if you have trademark, brand name associated with business or profession. Now Finance Act 2023 has made this section very exhaustive. Now they are not interested in taking individual names. Now they are saying any other intangible asset, copyright, trademark, license, franchise, this, that, everything is going to be covered over here. Everything, every kind of intangible assets. Listen carefully. If purchased from someone, then purchase price will become what? Your cost of acquisition. Or if self-generated, then you have to take that as what? Please tell me, nil. It is very simple. Now it has become very exhaustive. Earlier there was a limited list of items over here. Now any other intangible asset makes it very exhaustive. Okay. Sir, what about the cost of improvement on these items? Obviously on these items you will not get any cost of improvement. Okay. How can you make an improvement on goodwill? How can you make an improvement on trademark? Trademark is trademark, goodwill is goodwill. You cannot make any improvement. The cost of improvement on these items are not allowed. Okay. What about other assets? Other assets, you can take actual cost, whatever is your cost. Okay. You can take that. Now, coming to the next point. This was about what? This was about only intangible assets. Now, coming to these points. These intangible assets like goodwill of a business, goodwill of a profession, trademark, all these things. Even if it was acquired before 2001, now listen carefully, even if it was acquired when? Before 2001, then also the option to take FMV on 1/4/2001 is not available in these cases. Be very careful. Okay. Now let us talk about the cost of acquisition in case of bonus shares and units. By default, the cost of bonus share and unit is nil. But if it is acquired before 2001, if the bonus units were allotted before 2001, then you can take the cost as FMV on 1/4/2001. 1/4/2001 FMV can be taken as cost in case of what? Bonus shares and units also. What is the cost of acquisition in right shares, sir? Remember, I am a shareholder of a company. Company has given me the rights. Now, if I renounce the rights to someone, I will earn some money. Sir, what is the cost of that? The cost of that is 0, 0, 0. Suppose if I renounce the rights of the right share to my friend, I told him that you buy the shares, I don't want to buy, you pay me 10,000 rupees. So 10,000 is my sale consideration, cost of acquisition is 0. Okay. Now for my friend, what is the cost? My friend will go to company and will buy the shares. Suppose he went to the company and bought the shares for 1 lakh rupees. Now for him, the cost will not be 1 lakh, it will be 1 lakh 10,000 rupees. Two costs will be forming part of his cost. First is what he paid to me to acquire the rights. Second is what he paid to the company to acquire the shares. Is it clear, all of you? I hope it is clear. Next one, very important point. ICI favorite cost of acquisition point. This is if a land or building is acquired before 1/4/2001, then you will not directly compare the cost with FMV on 1/4/2001. Never ever. First, you have to compare the stamp duty value and FMV, and whichever is lower, and then you will compare the cost of acquisition, and then whichever is higher. This is only applicable for what? This is only applicable for what? For land and building. That too in here also. Stamp duty value will be compared with FMV. Listen carefully, very minute point. Only if stamp duty value is available with you. If stamp duty value is not available, then you have to ignore the stamp duty value point. Directly compare the FMV with what? With the cost of acquisition. Okay. Now let's move on to some special charging sections. We are going to deal with one special charging sections now. What is so special in these 4 charging sections? Let me tell you what is so special in these 4 charging sections. These 4 charging sections, general charging section says what? Capital gain will be chargeable in the previous year in which transfer took place. This is what the general charging section has to say. But these 4 special charging sections says that no. Capital gains will not be chargeable in the year of transfer, but it will be deferred in future years. Okay, because of some reason. We will defer your capital gain tax to what? To future years. We are not going to take tax today. We will take tax in future years. Now, why so? Which are those 4 cases? First one, section 45(1)(a), where your asset is insured, listen carefully, and it is destroyed because of some reason, then it is taxable in the year of receipt and not in the year of destruction. Okay. Suppose if your asset is destroyed in 23-24 and you receive the insurance claim, when? In 24-25, the tax will be charged in 24-25 and not 23-24. So year in which you receive the insurance claim, in that year you will be liable for tax. Sir, for determining whether the asset is long term or short term, till when we should compute the period of holding? The period of holding will be counted till the date of destruction. The indexation will also be taken till the date of what? Please tell me. Destruction only. It is only that the capital gains will be chargeable in the year in which you receive that money. Are you clear? Sir, if I don't receive the money, instead of money, if I receive the asset, then you can take the fair market value of the asset as the consideration. Sir, what if my asset is not insured only and it is destroyed? Then this section is not applicable. Then whatever is your loss is your capital loss, no treatment under the income tax law. Be very careful. Sir, what if my asset is a part of block of asset and it is destroyed, and if I receive the insurance claim? If your asset is a part of block and you receive the insurance claim, then you have to reduce it from the what? From the block of asset. Okay. So that much amount will be reduced from the block of asset. Okay. Next one, the second charging section, conversion of capital asset into stock in trade. Sir, when will the tax be charged? Listen carefully. You bought the capital asset, then you convert that into stock in trade. You bought the capital asset for 10 lakh rupees. Then you convert that on the date of conversion. It is 15 lakh rupees is the market value. Now, when you convert, we will not take the tax. We will take the tax on the date on which you sell the SIT. Okay. And in the year in which you sell the SIT, we will take the tax on capital gains also. We will take the tax on PGBP also. Sir, what will be the sale consideration for capital gains? See, it is very simple. First, it was capital asset. Then you convert it into SIT. This much appreciation will be capital gains. Then from capital asset, you sold that into what? As an SIT. So from year to year, it will be considered as what? The appreciation will be considered as PGBP. Okay. Now, therefore, FMV on the date of conversion minus cost will be your capital gains. And sale price of SIT minus FMV on the date of conversion will become your PGBP. Okay. Now, while computing capital gains, you will also check whether the asset is long term or short term. Sir, from where to where count? From date of purchase till the date of conversion, you have to count the period of holding. Okay. The indexation will also be available from date of purchase till the date of conversion. Period of holding, indexation, both will be counted till the date of conversion only. And then you have to determine whether the asset is long term or short term and accordingly take the indexation. Okay. I hope it is clear to all of you. Okay. Now, let's see the opposite, the vice versa of this case. When an SIT is converted into capital asset. For example, in 23-24, you bought a jewelry of 1 lakh rupees, which is your SIT. Now in 26-27, you converted that into a capital asset. Now this conversion will be called as what? Please tell me. PGBP. Because you are converting an SIT into capital asset. It's a reversal role reversal. Okay. And this conversion will be called as what? This sale will be called as what? This sale will be called as capital gains. Okay. Now listen carefully. One very important difference between this provision and the previous provision. Here you are going to pay tax in 26-27 only. Here there is no deferral which is allowed. Unlike the previous section. Here deferral is not allowed. Here you have to pay tax on 5 lakh minus 1 lakh. Today only in 26-27. Be very careful. And here you are going to pay tax in 31-32 on capital gains. Sir, whether the asset is long term or short term, how to determine? This will be counted from 2026-27. That is from the date of conversion till the date of sale. Sir, indexation also this year and this year. Date of sale and date of conversion, indexation will be available to you. Okay. Now. One last thing which I would like to say over here. Sir, when I will sell later on, what will be the cost of acquisition? The cost of acquisition will be 5 lakh rupees. That is the FMV on the date of conversion will become your cost of acquisition. Everything revolve around the date of conversion. Everything revolve around this. Okay. Sir, if this is not jewelry, but this is a fixed asset and I bring that fixed asset in my business, then what will be the actual cost? That is also as per explanation 1A I have left earlier, if you remember in PGBP. That is also FMV of the stock in trade on the date of what? On the date of conversion. Is it clear to all of you? I hope it is clear to all of you. So this is what this section is all about. Now we are moving ahead some dangerous provisions, okay, which is slightly difficult to explain in words, but still I will try my best to explain it in my words to the extent it is possible from my side, okay. Now, one is section 45 subsection 3. Sir, what is section 45 subsection 3? 45 subsection 3 says that when a partner of a firm or a member of an AOP transfer assets to partnership firm or transfer assets to AOP BOI, then the partner will be liable for capital gain tax. Okay. Now, what will be the sale consideration in the hands of partner? The sale consideration in the hands of partners will be the amount recorded in the books of accounts by the firm. Whatever is the amount which is recorded by the firm, that will be considered as what? As sale consideration in the hands of the partner. I hope it is clear to all of you. Now, we will move ahead towards some very dangerous provisions. That is section 9B and section 45 subsection 4. Now, it is not that easy to explain this in the form of words, but still I will try to explain to the extent it is possible from my side. Let me talk about first of all 9B. When is 9B attracted? 9B is attracted when a partnership firm or an AOP BOI gives something to the partner or the member. Okay. When a partnership firm or an AOP BOI gives something to the partner or the member. What is that something, sir? The partnership firm gives, I'm only talking about 9B as of now. I'm not interested in 45.4. Let's talk about both of them individually first and then we will combine both of them. 9B is attracted when listen, are you listening or not? Please tell me. 9B is talking about when a partnership firm gives what? Capital asset or stock in trade. To whom? To a partner. Why? What is the reason? What is the event? The event is either dissolution of the firm or either the reconstitution of the firm. Okay. What do I mean by reconstitution of the firm? Reconstitution is defined on the next page as either one or more partner leaves the partnership firm or one or more partners are admitted in the partnership firm or all the partners are same and there is a change in the respective share of the partners. Okay. So either the partners are leaving or partners are admitted or there are no admission or retirement, but just there is a change in the profit sharing ratio of all the partners. That can be called as what? Reconstitution. So this section is applicable in two circumstances, either on dissolution of the firm or either on reconstitution of the firm. Then in that case, the capital gains will be chargeable in whose hands? It will be chargeable in the hands of the entity. Entity means who? Partnership firm. Okay. Partnership firm, because partnership firm is transferring the asset, so partnership firm will pay the tax. Okay. Now, what are the two things that the partnership firm is transferring? Please tell me. There are two things which are capital asset and stock in trade. If a stock in trade is transferred, then PGBP will be paid by capital gains. If a capital asset is transferred, then capital gains will be paid by the partnership firm. Is everyone clear till here? Please tell me. So if a stock in trade is transferred, then PGBP. If a capital asset is transferred, then capital gains. Are you clear? 9B is very simple. Okay. Now coming to 45.4. What is 45.4, sir? 45.4 talks about when a partnership firm gives money, which was not covered in 9B, or gives capital asset, which was covered in 9B also. Remember? In 9B, capital asset was there. Here also capital asset was there. In 9B, money was not there. Instead of money, what was there? Stock in trade was there. Here, money is there. You are giving money to the partner. You are giving capital asset to the partner. Why are you giving? You are giving in one event, and that is reconstitution. Here, dissolution word is not there. Okay? Dissolution word is not there. Then the partnership firm will be liable for capital gains as follows. What is the formula? The formula is A is equal to B plus C minus D. Okay. Now what is A? A is your final answer. Final answer means the capital gains which is chargeable under 45.4. Are you clear? Now what is B? B is the money received by the partner. Okay. What is C? C is the capital asset, fair market value of the capital asset received by the partner. Is it clear to everyone till here? Please tell me. And what is D? D is the balance in the capital account of which partner? Of the partner who is going to leave the firm. Okay. It is the balance of that partner. Okay. Now, if the answer comes to negative, if it comes to negative, then you take it as 0. Okay. And in the capital account, you are not going to take few things. You are not going to take few things in the capital account. Without taking into account the increase in the capital account, any revaluation of asset will not be taken in the capital account. Any self-generated goodwill, if it is credited to capital account, do not take. Any other self-generated asset, if it is credited to capital account, do not take. Okay. Now, from here onwards, I have to explain you with the help of some story now. Otherwise, you will not understand from here onwards. Pay attention, please. Now, always remember, what is the procedure that you are going to follow in the exam while solving a question with respect to 9B and 45.4. Are you listening to me? Please tell me. Suppose there are 3 partners in the firm and one of the partner is retiring. Okay. One of the partner is retiring, and to that retiring partner, the book value of the asset was 50 lakh rupees. How much? 50 lakh rupees. And now we are revaluing that asset. Revaluing that asset at how much? Say 70 lakh rupees. And we are giving that asset to the partner. Okay. So whatever is the increase in the book value. Okay. How much is the increase in the book value? Please tell me. 20 lakh rupees. Is it clear? 20 lakh rupees increase in the book value. First of all, I have to record that in the books of accounts. Remember that in the accounting system, I have to increase my book value by 20 lakh rupees. Then from that, I have to pay whatever is my taxes. Remember that? And after that taxes, whatever is the amount, NPAT will come, that I have to distribute between all the partners. Remember? And then I will get point number D. Do not take directly D. Remember or not? You have to do this exercise before taking what? Before taking D. Are you clear? Now there are some questions. Whatever capital gain is charged under 45.4, there are few questions that we need to answer. Whatever capital gain is charged under section 45.4, what will be done with that? You have to attribute that capital gain to the remaining asset of the firm. Remember, how many lands were there? How many lands were there in the firm? 3 land was there. 3 partner were there. 3 land were there. 3 partner, 1 partner went. 2 partners still there? Yes. 2 land still there? Yes. Assume that all the lands were revalued by 20 lakh rupees. Assume that. Earlier, all the land were 50 lakhs. Then all the 3 lands were revalued at 20 lakhs, made it 70 lakhs. Now, whatever capital gains will come in 45(4), what will you do? You will attribute that to the remaining assets of the firm. Remaining assets of the firm in what ratio? In the ratio of revaluation done by you. Remember or not? In the ratio of revaluation done by you, or in the ratio of self-generated asset which you have recognized in the books of accounts. So if you have recognized some self-generated asset, or if you have revalued some asset, then you have to distribute that capital gains which is charged under 45(4) in the ratio of that. So in my case, there are 2 lands which are pending. By what ratio I have revalued them? I have revalued them by 20 lakhs. So I have to distribute my capital gains in the ratio of 20:20. That is 1:1. Are you clear or not? Please tell me. Now the next question which comes to my mind. Sir, if the other asset is, the remaining assets are depreciable assets, shall we attribute that to depreciable assets also? Yes. Even to depreciable assets you have to attribute. Even to non-depreciable assets you have to attribute to every asset which is there with the company in the ratio of revaluation, or in the ratio of generation of self-generated asset, patent, etc., whatever it is. One last thing. Sir, what 45(4), whatever capital gains comes in 45(4). Sir, what is the nature of that capital gains? How will I come to know the nature of that capital gains? Whether this capital gains B plus C minus D is long term or short term? How will I come to know that whether it is long term or short term? That also depends upon to which assets you are attributed. Okay. If you are attributing to what? Self-generated goodwill and all, then that much amount will be short term. If you are attributing to a short-term capital asset, then that much amount will be short term. If you are attributing to long-term capital asset, then it will be long term. If you are attributing to block of asset, then it is short term. Remember, for example, suppose in 45(4) the capital gains come to 10 lakh rupees. Okay, 45(4) capital gains is how much? 10 lakh. Now, how will you come to know what is the nature of this capital gain, whether it is long term or short term? That depends upon to whom you are attributing. Suppose out of that 10 lakh rupees, 3 lakh you are attributing to block of asset. So 3 lakh will be short term. 2 lakh you are attributing to 10-year-old land. Then that 2 lakh will be long term. Are you clear? 5 lakh you are attributing to say goodwill. Then that will also be short term. So like that you have to decide to whom you are attributing. That is what it is written over here. You can check it over here. Okay. I hope it is clear to all of you. So this is what this provision is all about from year till year. Now coming to the next point. For better understanding, obviously, you have to see the 3 CBDT circulars which I have done with you all in the class. Okay, that will be exhaustively explaining you the entire provision. Now, as per ICDS, if there is a dissolution of the partnership firm, at what value you will value the inventory? In case of a dissolution of a partnership firm, if the partnership firm is dissolved, whether the business is now discontinued or not, it doesn't matter. You will always value the inventory at the net realizable value, that is NRV. Okay, this is a small discussion, nothing great as such. So let's go ahead with the next point, and that is section 45 subsection 5. Here also the capital gain is not chargeable in the year of transfer, but it is deferred to future years. Okay. Now what is this case? This is a case of compulsory acquisition by the government. Okay. Now in case of the government compulsorily acquire your property, when is it taxable? Is it taxable in the year of acquisition? The answer is no. It is taxable in the year in which the original compensation or even the part of the original compensation is first received. Suppose if your part of the original compensation is received, then your entire compensation will be chargeable in that year itself. For example, the government has decided that your original compensation will be 5 lakh rupees. Now, if the government gives you even 1 lakh rupees now, then the entire compensation will be chargeable in the year in which you receive the 1 lakh rupees. Okay, be very careful with that. Secondly, enhanced compensation, sir, when it is chargeable? Suppose if you don't like the original compensation, you can file a suit in the court, and then the court will tell the government that give us some extra amount as enhanced compensation. So that is chargeable in the year in which you receive the enhanced compensation. Sir, what is the cost of acquisition of the enhanced compensation? Generally, the cost of acquisition of the enhanced compensation is nil. Okay, there is no cost attached to the enhanced compensation. But the government has said that if you have incurred some legal charges to fight the case, then those can be deductible from what? From the enhanced compensation. Okay. Now, suppose while fighting the case, I am dead, I am not alive, I am no more in this world, then in that case what will happen? Then in that case it will be taxable in the hands of your legal heir. Okay, whomsoever is receiving that money, that person will be liable for the tax on the enhanced compensation. Now the one last thing that I would like, last 2 things which I would like to say over here is, One thing is, sir, what is the nature of enhanced compensation? Whether it will be long term or whether it will be short term, that depends upon the nature of the original compensation. If the original compensation nature is long term, the enhanced is long term. If the original is short term, then the enhanced is also short term. Okay. Last but not least over here, sometimes what happens, the court gives an order, an interim order, and tells the government that pays some random amount to the assessee. Okay. So if the assessee receives something while an interim order, through an interim order, when it is taxable, is it taxable on the date of receipt? The answer is no. There is a proviso which says that an amount received under an interim order will be taxable not on receipt basis like this. These are taxable on receipt basis, but the interim order amount will not be taxable on receipt basis. It will be taxable in the previous year in which the final order is passed. Okay. So whenever the final order will be passed in that year, it will be taxable. Now, while capital gains is an important issue over here, income from other source is also an important issue over here. Sir, what about the treatment of interest which I will be receiving from the government for delay in paying the compensation? That interest will be chargeable on receipt basis. First of all, it will be chargeable under IFOS. Secondly, and then from here you are going to get 50% flat deduction under section 57. Be very careful. 50% flat deduction, you can claim it over here under the income tax law. Okay. One last thing I would like to say over here, that if you are not happy with the compensation and you went to the government and you went to the court, and if the court reduces your compensation, what does the court does? Court is not increasing your compensation. If the court is increasing the compensation, then you have to pay tax on enhanced compensation. What if the court reduces your compensation? Then in that case, the AO will go back and will rectify your order under section 155 subsection 16 within 4 years from the end of the financial year in which the order was passed. Okay. So if the court reduces your rectification, if the court reduces your amount of compensation, then the AO will go back and rectify your order within 4 years. Okay. Now, coming to the fourth and the last exception where the capital gain is deferred in future. Okay. First exception was insurance. Second exception was conversion of capital asset into stock in trade. Third exception was compulsory acquisition. Fourth exception is 45 subsection 5A, which is joint development agreement. And this fourth exception is very specifically only applicable to individuals and HUF. This is not applicable to other assessees. The first three were applicable to everybody, but this is only applicable to individuals and HUF and not to everyone. Okay. What is the individual HUF doing over here? The individual and HUF is giving its possession of land or building to a builder, to a project developer, and the project developer in return is giving what? It is giving money. Along with money, it is also giving some immobile property in the new project, some flats in the new project. So when it will be taxable? It will be taxable today? No. It will be deferred. Deferred to one, it will be taxed in the year of the completion of the project, in part or in full. Whenever the project will be completed, in that year it will be taxable. Till then we will not tax. Okay. What will be the sale consideration in that case? What will be my full value of consideration? The full value of consideration is whatever money you receive, that will be full value of consideration, plus whatever immobile property flats you are going to receive. You can take the stamp duty value of the flats on the date of completion certificate. Okay. So you have to take two things: money which you receive, and secondly the stamp duty value of the flats which you receive. Okay. Later on, whenever you will sell these flats, whatever is the full value of consideration over here, that itself will become your cost of acquisition in future. Be very careful. Okay. So whatever is your sale consideration, that will become your cost of acquisition in the future years. Now, this deferral is only allowed if you wait till the completion of the project. Suppose I gave the land in 22-23 and the project is about to complete in 27-28. Now I am in a hurry of money. I need some money. Urgency is there. So in 24-25, I am giving my rights to somebody and I am saying that I don't want to wait till 27-28. You please pay me the money. Then you have to pay the tax at that time only. Then you will not get the benefit of what? Deferral under the income tax law. Okay. Now there is one small clarificatory amendment which is made by Finance Act 2023. It's a clarificatory amendment. Okay. When you say the builder will give you cash, cash will only include cash or what? No. It will not only include cash. The builder can give you check also. The builder can give you draft also. The builder can make you payment by what? Any other mode also. The word used in the law was cash. So the cash will not only include cash. The government has clarified that builder will not give you cash. It will give you check, draft or any other mode also. It is allowed. Okay. Last but not least, when a builder is giving you two things, one, he is giving you money, another, he is giving you immobile property, flats in the new project. Now, the builder will deduct TDS on the monetary portion. On which portion builder will deduct TDS? On the monetary portion at 10%. On what basis? on payment or credit, whichever is earlier, if he is making payment to resident under 194 IC. So on monetary portion, he will deduct TDS at the rate of 10%, on payment or credit at the rate of 10% to resident person. If he is making the payment to non-resident, then the TDS will be deducted under section 195. Okay, there is no threshold over here of TDS, unlike other sections where there is some kind of threshold of 10,000, 20,000, 30,000, etc., etc., etc. Okay. Now, the next two provision I would like to explain you with the help of this chart, which I have made you write in the class itself, if you remember that. That is taxation of ULIP first of all, and then the taxation of what? The taxation of your life insurance policy amount received. Okay. Let me talk about ULIP first. ULIP and LIC, more or less, both of them are same only, except few changes are there, which I will make you understand with the help of this example. Okay. ULIP, unit linked insurance policy, if you are buying, then you have to check that when have you bought this policy. If you bought this policy before 31st of Jan, that is up to 31st of Jan 2021, then the treatment is different. And if you have policies issued on or after 1st of Feb 2021, then the treatment is different. Okay. Now, if it is issued till 31st of Jan 2021, then you have to fulfill only one criteria, that is percentage criteria. And if you fulfill the percentage criteria, your amount received will be exempt, exempt and exempt. What is that percentage criteria? Okay. That if the policy is issued after 1/4/2023 but before 31st March 2012, then your annual premium should be less than equal to 20% of sum assured. Okay. If the policy is issued after 1/4/2012 but before 31st March 2013, then your annual premium has to be just 10% of the sum assured. That's it. And if the policy is issued after 1/4/2013, then for normal person it is 10%, and for disabled person it is up to 15%. So if the policy, first of all, you have to check the date of the policy. If the policy is issued up to 31st of Jan 2021, then you have to follow only these percentages criteria. You have to check in which category you fall. You fall in the category of 2003 to 12 or 12 to 13 or after 13. Okay. Just check you are within the percentage. If you are within the percentage, then it is exempt. If you are outside the percentage, if you are not within the percentage, then it is taxable, and it is taxable as what? It is taxable as long-term capital gains, and the tax rate will be 20% as per section 112. Is it clear, all of you? 20% as per section 112. But now the game has changed with effect from 1st of Feb 2021. On or after 1st Feb 2021, you have to check two conditions, not one. If the policy is issued on or after 1st Feb 2021, two conditions are going to be checked by you. The first condition is the same one. First of all, check the first condition. You have to pass the test of the first condition first. Don't jump to the second condition directly. You have to go in the order of the law. If the first condition itself is not fulfilled, then you pay tax as per the old provision only. Are you clear or not? If you do not fulfill the first condition, then pay tax as per the old provision only. Long-term capital gains, section 112, 20% tax. But fortunately, if you fulfill the first condition, then now you have to fulfill one more condition, that your annual premium should not be more than what? 2.5 lakh rupees. So now, on or after 1st Feb 2021, you have to fulfill both the conditions. If the first condition is fulfilled, the second condition is fulfilled, capital gains exempt. If the first condition is not fulfilled, old provision 112. If the first condition is fulfilled, but the second one is not fulfilled, then you have to pay tax as per what? 112A, 10% tax, subject to an exemption of what? 1 lakh rupees. Okay. So just remember, for violating the first condition, pay tax as per the old provision. For violating the second condition, by fulfilling the first is fulfilled, second is violated, then pay tax as per the new provision 112A. Okay. Now, when you calculate annual premium, how will you calculate the annual premium? Annual premium is counted by taking the annual premium of aggregate of all the policies. Okay. So if you have taken 5 policies, then you have to aggregate all the policies, and then you have to consider the annual premium. For example, you can check over here. There are 3 policies over here. The annual premium of one is 1 lakh, one is 1.5 lakhs, and one is 2.5 lakhs. Now you cannot take all the 3 policies as exempt. No. You take either this exempt, then these 2 will be taxable. Okay. Or you can take either these 2 exempt, because the aggregate premium is up to 2.5 lakh, then this will become taxable. Are you clear? You have to take this decision at your end. Okay. On this, I have made you write lot of example, and I have also done lot of examples with you all in the class also, if you remember. Okay. So all these things are there over here. Okay. I hope it is clear. Now coming to the discussion of normal life insurance policy. ULIP is done now. Let's talk about the normal life insurance policy. Sir, what is the treatment of money received under a normal life insurance policy on maturity or on death, etc., etc., etc.? See, This treatment is not applicable to death because on death it is fully exempt. On death, whatever benefit you receive, it is exempt. ULIP is not covered here because ULIP we have already covered above. Okay. Keyman insurance policy also not covered here because Keyman insurance policy amount, whatever you receive, that is taxable, taxable and taxable. Okay. So these three things are not going to be covered over here because those are dealt somewhere else already. What is covered over here is apart from these three things. Now here the cutoff date is 31st March 2023 and 1st April 2023. If the policy is issued up to 31st March 2023, you only have to fulfill the percentage criteria. Same as ULIP, same. 10%, 20%, whatever was there, 20%, 10% and then 10 and 15, same. If you fulfill the percentage criteria, it is exempt. So up to 31st March 2023, there was nothing like amount criteria, only percentage criteria. Fulfill the percentage criteria, it is exempt. Okay, if you don't fulfill the percentage criteria, then it is taxable and a new provision is brought by Finance Act 2023. It is taxable under section 56, subsection 2, clause 13 as IFOS income. Okay, it is not taxable as a capital gains income, it is taxable as an IFOS income. Be very careful. Okay. Now, what if the policy is issued after 1/4/2023? If the policy is issued after 1/4/2023, always check first condition. Okay. First condition is percentage. If you don't fulfill the percentage criteria, IFOS. Okay. IFOS. If you fulfill the percentage criteria, then go and check the second condition, that is amount criteria. Here the amount criteria is how much? 5 lakh rupees. The aggregate premium of all the LIC policy should be what? Should be up to 5 lakh rupees. It should not exceed. If it is more than 5 lakh, then you have to again select between the term. Okay. If there are three policies of 4 lakh rupees, yeah, 2.5 lakh, 2.5 lakh, 2.5 lakh, three policies are there, then you have to select any two of them, whichever is more beneficial for you. Okay. Now, if you violate again any of the provision, the treatment, all of them are same only. It is income from other source only. Unlike ULIP. In ULIP, some cases it is 112. In ULIP, if you violate the amount criteria, that it is 112A, right or not? But here it is everywhere it is same. It is going to be income from other source under section 56 to 13. Sir, how much amount will be income from other source? That is an important issue. Very, very important. It is different from ULIP. Whatever amount the company has paid you on maturity or on withdrawal of the policy, including the bonus amount, you have to take that minus whatever premium you have paid, you have to reduce that. But while reducing the premium, you will not take those premium which you have claimed as a deduction earlier, say under 80C, etc. If you have claimed the deduction of that premium under 80C, etc., then you have no right to reduce from here. That premium will not be reduced over here. Okay. So it means, in short, if you have claimed a deduction under the PG, under the income tax law earlier, you will not get the benefit of deduction once again from here. That is a very important catch over here. I hope it is clear to all of you, these two provisions. Is it clear? So let's come back to the textbook now. There are some provisions which we'll see one by one. One is a very small provision, nothing great as such, 55A, reference to valuation officer. Whenever the assessing officer has some issue with reference to valuation of certain assets, especially while determining the fair market value of the assets, he can go to the valuation officer. In which all cases he can go to the valuation officer? Where he feels that the assessee has valued the asset, but it is at variance with the officer. Okay. So assessee has to register, assessee has to go to some registered valuer and has to get it registered and has to get it valued the asset. But as per the AO, it is at the variance. Therefore, the AO can tell that I'm going to the valuation officer. Similarly, if the difference between the fair market value is more than 15% or if it is more than 25,000 rupees, it's more than 15% or more than 25,000 rupees, either of the two, then also he can go. Then at the end, the government has said that depending upon the nature of the asset and the relevant circumstances, if it is necessary, he can go for the reference to the valuation officer. Okay. So who are these valuation officers? These are departmental officers only, which are experts in valuing the assets. Okay. Now coming to some very, very, very important provisions of the income tax law of capital gains. That is section 50C. Very, very, very important. 50C is applicable for immobile property, land and building. So if you sell your land and building to somebody, then your full value of consideration will be the sale consideration or the stamp duty value, whichever is higher. Okay. But when it will be whichever is higher? When the difference between the two is more than how much? 110%. Okay. Then only this provision is applicable. For example, if your sale consideration is 100 lakhs and if your stamp duty value is 130 lakhs, then it can be called as what? Whichever is higher. But if the sale consideration is 100 lakh, but if your stamp duty value is 105 lakhs, then the difference between the two is less than 110%. Then you will not take whichever is higher. Then you will take the actual sale consideration. Okay. I will take the numbers as follows for the further discussion. My sale consideration is 100 lakhs and my stamp duty value is 150 lakhs. I will use this number throughout this example. Okay. So suppose my sale consideration is 100, stamp duty value 150 lakhs. I have to take whichever is higher because the difference between the two is more than 110%. Now, who determines the stamp duty value? My 150 lakhs is determined by whom? It is determined by the state government. Now, I am not happy with the state government. So, I can file a case against state government. And then the state government will decide, then the court will decide after 10-15 years. Wait for that much time, okay? And whenever the court will decide, at that point of time, what? After 10 years, 15 years, whenever the court will decide, at that point of time, the AO will do what? See your next page. The AO will rectify your order within 4 years, okay? Accordingly, if the court increases, then the AO will increase. If the court reduces, then the AO will reduce, as the case may be, okay? Now, coming to, I don't want to follow such a long procedure in my life. I want to go for some simple procedure, yaar. What is a simple procedure, sir? I am not happy with 150 lakhs. What shall I do? I should go to the departmental valuation officer. I will go to assessing officer, and assessing officer will refer the valuation what? To the departmental valuation officer. Now, suppose if the departmental valuation officer increases the value to 180 lakhs, okay, then my value will become 150 lakhs. Is it clear? If it is reduces the value to what? 130 lakhs, then my value will become what? 130 lakhs. But one very important catch over here where a student can make a mistake is, if the departmental valuation officer reduces the value from 150 lakhs to 105 lakhs. How much? 105 lakhs. That is less than 110% also. Then I have to take the sale consideration as 100 lakhs only. Okay, be very careful, because for this provision to apply, at least more than 100% difference has to be there. If the actual value is 100 and the departmental valuation officer reduces the value to 105 lakhs, the difference is only 5%. Therefore, this particular section cannot be made applicable. Okay. Now, one again very important issue for your exam, which is given over here. Sir, which date stamp duty value has to be taken? Sir, on the date of agreement, the stamp duty value is different. Later on, after few months, we are registering the property. On that day, the stamp duty value is different. Sir, which day stamp duty value should be taken? This is a very important example, very important provision which is tested in the ICI exam again and again. Sir, on the date of agreement, the stamp duty value is 50 lakhs. On the date of registration, the stamp duty value is 70 lakhs. Which day stamp duty value should I take? Listen carefully. You can take the stamp duty value of the date of agreement, provided you fulfill two conditions. If you fulfill two conditions, you take the date or the stamp duty value on the date of agreement. Sir, what are those two conditions? You have to receive an advance on or before the date of agreement. Okay, first condition. Second condition, you have to receive the advance by 4 modes. Account pay check, account pay draft, ECS or such other electronic mode. If you fulfill these two conditions, you will take the stamp duty value on the date of agreement. If you violate any of the condition, then you will go to future date. That is what? The date of registration, whatever is the value at that time. That will be your comparable amount for the purpose of this section. Okay. Last but not least, sir, what if my property is not registered with the stamp duty authority? If your property is not registered with your stamp duty authority, then assume that what could have been the stamp duty value if I would have gone to for registration, that value will be considered for the purpose of what? Section 50C. There are a lot of people when they especially do a close transactions within themselves. I am selling to my uncle is selling to me, I am selling to my father, my father is selling to my mother. We might not register the property with the stamp duty authority. In that case also you have to see the sale consideration along with stamp duty value. Then in that case you have to assume that if we would have gone for registration, what could have been the value? That value will be used for the purpose of section 50C. I hope it is clear to all of you. Next one, 50CA, a small version of 50C, which is applicable only for what? Unquoted shares. Unquoted shares means what kind of shares? Please tell me. Unquoted shares means unlisted shares. So in case of unlisted shares, you have to take the sale consideration as your actual price or the fair market value of the shares, whichever is, please tell me, whichever is higher. Okay. Now you also have to consider this from the perspective of the buyer. If the buyer is also buying at a lower price, do you remember that? If the buyer is buying at a lower price and if the price is lower than 50,000 rupees, okay, then the buyer will also be liable for what? Income from other source. Are you clear or not? Please tell me. In some specified cases, this section is not applicable. There are some places which are prescribed by the government. In that it is not applicable. Those are covered in section 79 also. That is in case if a company is into losses and the central government has moved a petition to whom? Central government has, remember section 79 we have done some cases. The central government moves a petition to the NCLT, National Company Law Tribunal, and the National Company Law Tribunal debarred all the directors. They have suspended all the directors and they are bringing new shareholders at that point of time. If you sell the shares at what? Lower than the fair market value, then also it is allowed to them. Okay. Last but not least over here is section 50D. If you are selling something to somebody, listen carefully, and if you are not able to determine the sale consideration of that, okay, suppose you have sold something to someone, but the sale consideration is indeterminable, it is unknown, then the sale consideration should be taken as the FMV of the asset transferred. Whatever asset you are transferring to somebody now, that asset's FMV should be taken as what? As the sale consideration as per section 50D. Now let's come to the next point, and that is the Finance Act 2023 amendment, a small one, a simple one, nothing great as such. Sir, what is covered in this particular section? This section 50AA is here to discourage few people, that is certain specified mutual fund and also to market linked debentures. So market linked debentures and specified mutual funds are covered over here. Sir, what is specified mutual fund? Specified mutual fund, is there any definition? The answer is yes. It's a mutual fund in which not more than 35% is equity shares of domestic company. It means 65% has to be dead and dead. It means it's a dead mutual fund. It's not an equity mutual fund. Okay. Secondly, the units of this is acquired on or after 1st April 2023. If you have acquired before 2023, then it cannot be called a specified mutual fund. It is only applicable if you have acquired on or after 1st April 2023. Okay. What are market linked debentures? Market linked debentures are non-convertible debentures. They are linked to certain performance of the market like Nifty, Sensex, government securities, etc., etc. You are not going to get any fixed return over here except at maturity. Okay. Generally, they don't have fixed tenure, but it is generally between 12 to 16 months, approximately 5 years. Okay. Now, what is the exact what is the exact treatment over here? I'm coming to the treatment, tax treatment. I'm not getting into the financial management of the securities. I'm coming to the tax treatment. The tax treatment is very simple. Whether it is a mutual fund, specified mutual fund, that is dead mutual fund, or whether it is a market link debenture, there are some bad news for you. You will get the deduction of cost of acquisition, definitely. You will get the deduction of expenses on transfer, definitely. But after that, whatever is the profit is always going to be short-term capital gains. Okay, whether it is after 36 months or after 5 years or 10 years or 20 years. Therefore, it is always short-term capital gain. Therefore, the question of indexation will never arise, yes or no. Because it is short-term, the question of indexation will never arise. Similarly, the tax rates will also be higher, right or not? Yes or no? Similarly, one more thing which is generally not allowed, here also not allowed. STT also not allowed if you are paying some STT on purchase or sale of the securities. Okay. Securities transaction tax will not be allowed to you. So this is a disadvantage which is given by the government to dead mutual fund. They are discouraging dead mutual fund. They are encouraging equity oriented mutual fund. They are telling you to invest in equity markets rather than to invest in the debt markets. Okay. Anyway, slump sale. Slump sale. What is slump sale, sir? For slump sale, we need to understand the definition of slump sale, and then we need to understand the tax calculation of the slump sale, how capital gains is computed in case of slump sale. Okay, pay attention, please. What is slump sale? Slump sale is nothing but you are making a lump sum sale of a business in a lump sum sale of one of the undertaking of the business. You have multiple departments in your business, multiple divisions in your business. One of the divisions is not performing that well. You're not satisfied with that. You want to focus on other aspects of the business rather than putting your energy unnecessarily on that area. Therefore, I would like to sell off that particular business for a lump sum amount. Okay. I'm not interested in individually valuing any assets and liability. I'm not interested in negotiating for individual assets and liabilities with the other person. I want a buyer who can come to my business, take the business outrightly and pay me one lump sum amount. That's it. So therefore, what is a slump sale? Slump sale means a transfer of one or more undertaking for a lump sum consideration without assigning individual values to any asset and liabilities. Okay. I'm not going to write the individual. I'm not going to write in the agreement that this much is furniture, this much is machinery, this much is data, this much. I'm not interested in all these things. I want that you come to my business, see the business, you like the business, you take it, give me 100 crore, 200 crore, whatever it is, and get away from here. Okay. This is slump sale. But there is a state government requirement that in every transaction where you sell a land and building, you need to mention the value of stamp duty value of land and building in the agreement. So if I'm mentioning the stamp duty value in the agreement, then that is allowed under slump sale. Okay, because that is a government requirement. Okay. Now, am I going to sell the individual assets? No, individual assets are not going to be sold over here. You are going to sell a lump sum for a lump sum consideration. Sir, whether the lump sum sale consideration, whatever is the capital gains, whether it will be long term or short term, how will I determine? For that, you have to see when you have undertaking was set up. If your undertaking was set up more than 36 months old, then it is long term. If your undertaking was set up to 36 months, then it is short term. Okay. So you have to check the period of holding of the undertaking. Okay. If the undertaking is very old, then it is long term. If it is not old, just 1 or 2 years old, then it is short term. As simple as that. Okay. Sir, for stock also, I have to compute separate PGBP. Nothing will be computed separate. PGBP, VGBP or IFO is nothing. Everything will be coming under capital gains only. Sir, indexation will be allowed. Indexation not allowed under slump sale. Before this, indexation was not allowed. Where? Which all places indexation was not allowed to you under first proviso to 40 1978, indexation was not allowed on bonds and debentures, indexation was not allowed on market linked debentures and specified mutual fund, and this is the fourth time where indexation government is not allowing you. Okay, I hope you remember that. Now, how will we calculate the capital gain, sir? Very simple, formula is simple, but internal calculation is very difficult. Sale consideration minus net worth of the undertaking will be considered as cost of acquisition. That will be your long-term or short-term capital gain. So long-term, short-term, how does it matter? It matters. Indexation is not allowed, but tax rates will differ now for long-term and short-term. Yes or no? Indexation will not be allowed, but long-term will be taxed at lower rate, short-term will be taxed at higher rate. At that point of time, it will make a difference. Okay, otherwise there is no difference as far as the amount is considered. The amount of long-term and short-term capital gains will remain same only because there is no indexation. Okay. Now, sir, how to determine these values, sir? Now, let me explain you one by one. First of all, I will explain you the net worth. Net worth means the cost. How will I determine the cost of acquisition of the undertaking? So for determining the cost of acquisition of the undertaking, you have to first of all see, you have to divide all the assets and liabilities into various categories. First of all, what is the net worth of the undertaking? Net worth of the undertaking is nothing but aggregate value of all assets minus aggregate value of all liabilities of the undertaking in the books of account. Sir, how will I determine the aggregate value of all assets? Listen, for that purpose, all the assets are categorized into four types. First, depreciable asset. Second, 3580 asset. Third, self-generated goodwill. And fourth is other assets. Okay. Now, how will I... This is what we are computing. We are not computing sale consideration. We are computing cost first. Okay. Cost. For cost is net worth. Net worth is asset minus liability, and assets are categorized into four parts. First, depreciable asset. Depreciable asset will be valued as per the income tax law WDV. WDV as per the income tax act. Okay. And 3580 assets, if it is there, then the value of that will be nil because you have already claimed 100% deduction on that under PGBP. Okay. Self-generated asset will be nil. Self-generated goodwill will be nil, and all other assets will be considered as book value, book value, book value. For none of the assets, you are not going to take market value. You are going to take either income tax WDV or book value or nil. Okay. For none of the assets, you are not going to take revaluation. If there is any revaluation, you have to ignore the revaluation blindly. Okay. Now, coming to the next part. What is the liability, sir? Liability will be what? Liability will be valued at book value. Don't have to think much about liabilities. Liabilities will be valued at book value. Contingent liabilities are to be ignored, are to be ignored, are to be ignored. Okay. As simple as that. One or two points I will say, then I will come to the sale consideration part. Okay. Sir, if there is an undertaking which is transferred to someone, what about the losses and UAD of that undertaking? Will that also be transferred? It will not be transferred. The losses and UAD will continue to be carried forward by the existing company, and the existing company will carry forward and set off that loss. It will not be transferred to the new entity. Okay. Sir, is 50B mandatory? Obviously not mandatory. How the hell the government can tell you that you have to sell lump sum only? I can individually sell, and if by selling individually I can have a lower capital gains, I can have a lower tax, then I can do that. Then I have to face all those difficulties of selling the assets individually. That is a different thing. That's your business decision. What is better, that I'm not interested in telling under taxation at least. Okay. What is better for you? You have to do the individual calculation and decide which is more better for you. Okay. Now coming to the discussion of what the most important part over here. Sir, how to value the sale consideration? So net worth, you explained how to value sale consideration. For that also now the government has brought 2 years back Rule 11 UAE. And here there are government is saying that we are going to compute 2 FMV. 2 FMV has to be computed, not 1. And then whichever is higher will be considered as what? As your sale consideration. Okay. FMV1, I will tell you the significance of FMV1. See here please. FMV1 is the FMV of the asset which you are transferring. Whatever assets which you are transferring now, okay, you have to take the FMV of that in FMV1. Sir, what is FMV2, sir? FMV2 is the FMV of the assets which you are receiving. Okay, what will you receive? You will receive either money or you will receive either what? Non-monetary items, that is assets. Okay, so FMV1 is what we give, FMV2 is what we receive. Okay, now how the government has categorized all the assets and liabilities into as follows. So how to determine FMV1? Again, I am saying FMV1 is what we give. What we give is FMV1. So what we give is FMV1. So how to determine that? A plus B plus C plus D minus L, where A, B, C, D are assets and L is your liability. Okay. So they have divided all the assets into 4 categories. Category number A, you have to take book value of all assets. All assets book value. All assets. Take the balance sheet, add the total the balance sheet and take it. Don't take jewelry, artistic work. Why, sir? Because that will be valued as per point number B. Check please. That will come in point number B. Jewelry and artistic work will be valued based on valuation report. Okay. A valuer will do the valuation. Market value will be the value over here. Second, don't take shares and securities. Why, sir? Because shares and securities will be done as per Rule 11 UA FMV. Don't take shares and security also. Don't take book value of that. Third, don't take immobile property. Why, sir? Because for immobile property there is stamp duty value. Okay. So you are not supposed to take 3 things: jewelry and artistic work, shares and securities, immobile property. Apart from that, every other asset will be valued at what? Will be valued at book value, book value, book value. while taking the total assets, don't take two more assets. Two more assets will not come only. That is, if there is any income tax on the asset side like advance tax, TDS, etc., which is there, don't take. And if there is any fictitious assets like miscellaneous expenditure, etc., which is there on the asset side, don't take. Okay. So these two assets will never ever come, and rest of the assets, I'm not saying don't take. It will be coming in point number B, C, and D. Okay. B, C, and D, it will come. Okay. Now this will complete your A plus B plus C plus D. Sir, what is L? L is the total of all the liabilities. Take the book value of again all the liabilities which is there in the balance sheet. But you will not take few liabilities. Okay. Few liabilities will not be taken. First, don't take paid up capital of equity shares when you take the total of the liability. Okay. Don't take any amount set apart for payment of dividend on preference shares, etc., etc., etc. In the balance sheet, if you have set apart some portion as a payment of dividend to the shareholders, don't take that much amount. Third, don't take reserves and surplus, but you have to take this reserves and surplus which is set apart towards depreciation. If your reserves and surplus is set apart toward depreciation, take that. Okay. Then fourth, don't take provision for tax, etc. Okay. If there is some provision for tax on the liability side, don't take. Don't take a certain liability. You are reading the exclusion, huh? You are not reading the inclusion. You are reading what should not be taken. Okay. Then don't take contingent liability. Don't take. But in that, take one thing, that is arrears of dividends payable in respect of cumulative preference shares. Okay. So in exclusion also there are two exclusions. Which are the two exclusions in exclusions? Exclusion ka exclusion will be called as inclusion, obviously. Yes. So this is an exclusion ka exclusion. You will include this. This is an exclusion ka exclusion. You will include this also, which I have done it in green. Okay. Now this is your FMV1. Here the solution doesn't end. You also have to compute FMV2. What is FMV2? FMV2 is what you receive. What you receive from the buyer. So what will I receive? E plus F plus G plus H. So buyer will give you what? Monetary consideration. First of all, money. Take money, money, money. What is FGH? FGH is the value of non-monetary items. They have divided all the assets into three categories, not four categories. First, F. FMV of non-monetary items referred in Rule 11 UA. So whatever assets which you are receiving, if it is covered in Rule 11 UA, then value as per Rule 11 UA. In Rule 11 UA, there is shares, there is jewelry, all those things are covered. Okay. So value as per Rule 11 UA. Then point number G. FMV of assets other than immobile property and other than Rule 11 UA. Why other than Rule 11 UA? Because Rule 11 UA was already covered in point number F. Why other than immobile property? Because that is already covered in point number H. So what will come in point number G? Point number G will cover FMV of other assets which is not covered in 11 UA, which is not immobile property. Maybe some assets which are not covered in 11 UA. Sir, can you give some example? Yes. Like cryptocurrency. If you go and see the Rule 11 UA chapter in our book, you will not find cryptocurrency in Rule 11 UA. So for cryptocurrency, you will follow what? You will follow point number G, and as per point number G, you have to take the FMV of the cryptocurrency. Okay. So that is the value you are going to take. And for immobile property, again, you are going to take what? The stamp duty value. Whichever is, all these things will be added. E plus F plus G plus H, and then compare with FMV1. Whichever is what? Whichever is higher, that will be considered to be your sale consideration. Okay. So this is a question which can come in the exam. If it comes, it will come for at least 8 to 10 marks, not below that. Or it can come in the form of a case scenario in your MCQ for at least 10 marks, not below that. Okay. Now let's move on to some other chapter, that is non-taxable transfers. What are non-taxable transfers? Non-taxable transfer means a transfer where capital gains will not be chargeable to you. Sir, which are those cases where capital gains is not chargeable? Like, there are a lot of cases now I'm going to speak over here, but I'm starting with some simple one first of all, where an HUF gives assets on partition, then it is not taxable. Or if you give an asset under gift, if I give you a gift, then it is non-taxable transfer. Or if I give you some assets under will, then it is non-taxable transfer. Or irrevocable trust means something for a very long period of time. Say for 10-15 years I am giving you something, then that is also non-taxable transfer. Then amalgamation, if I give you something, that is also non-taxable transfer. Regarding amalgamation, we will do detailed discussion in some time. Okay. Then the next one I am telling you right now, very, very important point. If a holding company gives something to an subsidiary, it is non-taxable transfer subject to some condition. Listen carefully. And vice versa is also not taxable. If a subsidiary gives something to holding, then also not taxable. But there are a lot of conditions. Condition number one, the holding and the subsidiary relationship has to be 100% relationship. How much? 100% relationship. Secondly, the recipient entity, the recipient has to be an Indian company. Okay. The recipient has to be Indian company. Third condition, they should not do two things for 8 years. two things should not be done for a period of 8 years from the date of transfer. That is, the recipient entity should not convert the capital asset into stock in trade for 8 years. Okay, they should not make this mistake. And the recipient and the holding company should be a 100% holding company for a period of 8 years. If they violate any of the two conditions, then whatever capital gain was exempt earlier, that will be what? That will be reversed. The AO will rectify your order and the exemption will be revoked from you and you will be liable for tax. Is it clear to all of you? Please tell me. Next one. There are certain cases of succession where capital gains will not be chargeable. Now we are going to talk about all of them in great detail. We are going to talk about amalgamation in great detail, succession in great detail. All of them are separately covered in the later chapter. Okay. I am over here to explain you certain things. That what is the second cost of acquisition? I have told you about the first cost of acquisition in section 55 in the very first chapter. Remember or not? Please tell me. Cost of acquisition of self-generated assets, cost of acquisition of goodwill, cost of acquisition of bonus shares, cost of acquisition of right shares, cost of acquisition of land and building. Yes or no? Now let's talk about cost of acquisition in some special cases where I receive an asset by way of gift, or where I receive an asset by way of will, or where I receive an asset by way of what? Amalgamation, or where I receive an asset by way of partition of HUF, or where I receive an asset by way of holding subsidiary, or where I receive asset by way of succession. I'm talking about all these cases. Can you make out that? Can you understand that or not? I'm talking about these cases. Let me take one of the example. Say for example, I'll take one of them as an example. Suppose I receive gift by way, I receive asset by way of gift. Then what will be the actual cost in my case? Because when I receive the asset by way of gift, I have not paid anything for that, right? What will be the actual cost? So for that purpose, the government has said that in all these cases, which I am mentioning over here, all these cases, the actual cost will be the cost to the, please say, the previous owner. Whatever is the cost to the previous owner, that will become my actual cost. Okay. Sir, what if the previous owner has also acquired by way of gift, sir? My father has given gift to my mother. My mother has given gift to me. Sir, for me, the previous owner is my mother, but my mother has also got the asset for free, sir. Then what will be the actual cost? Then in that case, the actual cost will be the actual cost of that previous owner who has actually paid for that. That is my father, and my father, right? Secondly, let's come to the single loop. I don't want to make multiple loops. My father has gifted me some asset. Sir, what will be the actual cost? The cost in the hands of my father, previous owner. Sir, whether the period of holding will be clubbed or not to determine whether the asset is long term or not. Yes, the period of holding of previous owner will also be clubbed as per explanation to section 242A to determine whether the asset is what? Long term or short term. There is no second doubt about it. There is no second thought about it. The period of holding will always be clubbed. Don't make any confusion over here. Okay. Next one. Sir, the indexation will be allowed from when? There is a doubt over here. Here there is a doubt. The indexation will be allowed from where? The Income Tax Act says that the indexation will be allowed from the year in which you receive the asset. Okay. In which you receive the asset. Suppose I received the asset in 2022. So indexation will be counted from 2022. But the Bombay High Court, in the case of Manjula Jesha, says that the indexation should be counted from where? Please tell me. From the day on which the previous owner has bought the asset. That is the day on which your father has bought the asset. Correct? So these are the two views. Here there is a confusion. Okay. But there is no confusion in clubbing of period. Period will be clubbed 100%. Everybody says that. But indexation from where to take? There is a confusion. And both the confusions are correct. Practically you can do both. Academically also you can do both. You can write one and you can write second as an alternate answer. Okay. This you have been doing in your CA inter exams also, I hope. Next one. RM Arunachalam, Ashok Kumar, Aditya Kumar Jajodia, Supreme Court and Calcutta High Court judgment 2018. Supreme Court judgment was an old judgment. Calcutta High Court judgment was a recent judgment. What has happened in this case? Suppose there is one father who has bought some property of 10 lakh rupees and after that the father has mortgaged that property in the bank and has taken a loan, and after that the father is dead and the property rights has been inherited to the son. Now, has the son got the property? The answer is no. The son has got the rights of the property. The property is not with the son. The son has only got the rights of the property because the property is hypothecated in the bank. Now, suppose if the son repays that loan to acquire the rights of the property, whether he will get the deduction of that loan as a cost of acquisition, this is what the Supreme Court has said that the answer is yes. The son will get the deduction of that cost of acquisition. As per the Supreme Court judgment of RM Arunachalam, which is repeated in Aditya Kumar Jajodia, Calcutta High Court judgment 2018. Now, similar issue was there. Not similar, slightly different. Father has taken a loan on a property. Father did not die. Now, father wants to repay the loan to sell the property. Whether the father will get the deduction, the answer is no. Moral of the story, to claim the deduction, you have to die. Okay, only then your son will get the deduction of the interest of the loan repayment. If I am alive, I am taking a loan, I am taking a property. Now I am making a story that because I want to sell the property, I have to repay the loan. Because you have yourself created the what? The title as encumbrance in the title. And if you yourself have created an encumbrance in the title and you are only clearing the title, then you will not get the deduction. If the encumbrance was created by previous owner and you are creating that title, then you can claim that as a deduction. Is it clear, all of you? Please tell me. This was held by VSMR Jagadish Chandran. Now, one small amendment which is made by Finance Act 2023, nothing great as such, very logical, that if you have a gold, you can go to the government and convert that gold into what? Electronic gold receipt, EGR. Or if you have an EGR, electronic gold, you can also convert that into what? In a physical gold. Okay, you can do either of the way. So whatever you do, that is exempt under section 47. Is it clear? Please tell me. That is exempt under section 47. If you convert a gold into EGR or EGR into gold, that is exempt. Sir, if I convert a gold into EGR and if I sell the EGR later on, then what will be the cost of acquisition? The cost of EGR will be the cost of gold. The period of holding will be what? It will be clubbed from the day one. Don't worry. It's a very, very simple calculation, nothing great as such. Okay. So if you are converting exempt, later on when you will sell, period of holding, you have to take it from the beginning. The period of holding will be taken from beginning and the cost of acquisition will be the cost to the EGR only. Okay. Nothing great as such. Now coming to some very important provisions, that is taxation of amalgamation. What does government has to say about amalgamation? What is amalgamation? First of all, we need to understand a lot of aspects over here. The very first thing that we need to understand over here is meaning of amalgamation. Secondly, taxability in different hands. Like what is the taxability in the hands of shareholders of amalgamating company? What is the taxability in the hands of the amalgamating company? What is the taxability in the hands of amalgamated company? And then we also have to see whether the amalgamating company can transfer the losses and the UAD to the amalgamated company or not. Are you able to understand this or not? Please tell me. Therefore, let us start with the definition of amalgamation first of all. The amalgamation is defined under section 2(1)(b). What does it mean, sir? It means nothing but merger of few companies with each other where they have to fulfill few conditions. First, all the properties and all the liabilities have to be transferred to the amalgamated company. All, not even a single small button also should not be left. Small pin also should not be left. Everything should be transferred to the amalgamated company. Second, at least 75% of the shareholders should agree to this and should be transferred to what? Please tell me. Amalgamated company. When I say 75% of the shareholders in value, not in head count. Okay. In value should be transferred to there. Okay. Now coming to what? Coming to the taxability. There is one, listen here, see here. Let us create one example in our mind. There is one amalgamating company over here. There is one amalgamated company over here. And there are some shareholders of the amalgamating company over here. That is the selling company. Okay. Now, what is the treatment in the hands of the selling company shareholders? What is the treatment in the hands of the amalgamating company shareholders? See, they only have to do one thing. Give the shares back and take the shares in the new company. Okay. And the new company has to be an Indian company. Is it clear? If they give the shares back of the old company and take the shares of the new Indian company, then their capital gains will be exempt. Are you clear? Please tell me. It is exempt under the income tax law. Okay. Sir, what will be the cost of acquisition later on in the hands of the shareholder? The cost will be the cost to the previous share. What will be the cost of the amalgamated company shares? That will be the same as the cost in the amalgamating company shares. Sir, period of holding can be clubbed? Yes, you can club the period of holding and determine whether the asset is what? Long term or short term. You are free to do that. Okay. Next one. Sir, what is the treatment in the hands of amalgamating company? Amalgamating company will do only one thing. Whatever capital assets is there with the amalgamating company, they will transfer all the capital assets to the amalgamated company. Then there is no capital gains on that. That is exempt under section 47. Now, amalgamating company only has to fulfill one condition. That the amalgamating company, whatever capital assets are transferred to the amalgamated company, it is exempt, subject to only one condition. This amalgamated company has to be what? Has to be an Indian company. Okay. The recipient has to be an Indian company, then it is exempt. Then in between, there is one small provision which is coming, so I am addressing that. It's an amalgamation of foreign companies. Okay. Suppose there is an Indian company over here in India and there is one foreign company which is there in United States. Okay. Now that foreign company is holding some shares in the Indian company. Listen carefully, Kashish. That foreign company is holding some shares in the Indian company. Okay. Now that foreign company of US is getting amalgamated with a UK company. Okay. So that foreign company is getting amalgamated with a UK company. So that foreign company, US company, will be called as foreign amalgamating company and the UK company will be called as foreign amalgamated company. So if there is an amalgamation of a foreign company with another foreign company, in that process unnecessarily the Indian company shares are transferred, yes or no? So if an Indian company shares are transferred, income is deemed to accrue or arise in India, that will be taxable in India, but the government has said that we will not take tax in case of such amalgamations of foreign company, provided the foreign amalgamation companies have to fulfill two conditions. First, at least 25% of the shareholders of the foreign amalgamating company, that is US company, should continue to be the shareholders of the UK company. Is it clear? I hope it is clear. Second condition, such transaction should not attract capital gains in US. Okay, in US, in the country of amalgamating company, such capital gain should not be charged. If US is not charging, then we will not charge. If US is charging, then we will also charge, and the matter will be decided by DTAA then. Okay, if US is exempting, then we are exempting. Otherwise, we are not going to exempt you under any circumstance. Okay, now coming to the next point, very important point. One of the reasons why amalgamations are done in this country, and that is to carry forward and set off the losses of the amalgamating company in the hands of the amalgamated company, which is covered under section 72A. First of all, only the following companies will be allowed to carry forward their losses. Everybody is not allowed to carry forward loss under amalgamation. Amalgamation is exempt for every company. Listen carefully. Yeah? These are two different aspects. Amalgamation is exemption is for everybody. Exemption is for everybody. But carry forward of losses is only for limited companies. Okay. Now, which are those lucky companies to whom we can carry forward the losses? First of all, a company owning an industrial undertaking. You will ask me, sir, what do I mean by industrial undertaking? You have to come to next page and you have to see a long list. What does it include? Come over here, next page. It includes manufacturing or processing of goods. If you are engaged in manufacturing or processing of goods, you can call yourself as an industrial undertaking. Okay. Or if you are engaged in manufacturing of computer software, you can call yourself as an industrial undertaking. Or if you are engaged in electricity generation or telecommunication services or internet services, etc., broadband network, etc., cellular, then you can call yourself as an industrial undertaking. Or if you are engaged in mining services, you can call yourself as an industrial undertaking. Or construction of ships, aircrafts and rail system, all these people are called as industrial undertaking. If there are losses in their business, they can carry forward the losses by amalgamating with another company. Okay, they can do so. Similarly, if your company is owning a ship or a hotel with another company, you can carry forward the loss. If you are a banking company, you are doing amalgamation with certain specified banks, you can carry forward the loss. If you are a public sector company, you are doing amalgamation with another public sector company, you can carry forward the loss. Or if you are a public sector company who is doing strategic disinvestment like Air India, and if you are completing your amalgamation project within 5 years, the amalgamation is carried out, then also you can carry forward the loss. Okay, you can carry forward the loss. So in first case, a company was certain specified companies like industrial undertaking. In second case, it was banking. In third case, PSU with PSU. And in fourth case, it is PSU which is getting what? Transferred to what? Private players. Like Air India government company got transferred to what? Tata. Okay. Now, the Finance Act 2023 has given us clarification amendment that what do I mean by strategic disinvestment. So the government has said that where the government reduces its shareholding below 51% and also transfer the control to the buyer, that will be called as what? Please tell me. Strategic disinvestment. So unless and until the government of India is ready to reduce its shareholder below 51% and also transfer the control to what? To Tata's, till then it cannot be called as what? A strategic disinvestment. Okay. Now, there are some conditions which we have to fulfill. Come to page number 34.5. Amalgamating company has to. This was only the list of companies who are eligible for what? Amalgamation. Okay. Now I am talking about the conditions to be satisfied by amalgamating company. What are the conditions that amalgamating company has to satisfy so that it can claim what? It can transfer the loss to amalgamated company. Amalgamating company has to fulfill two conditions. First, amalgamating company has to be at least 3 years old. How many year old? At least the business of the amalgamating company has to be 3 year old. Okay. And amalgamating company should hold at least 75% of the book value of the fixed assets which it was holding 2 years back. Okay. So suppose today is the date of amalgamation, go 2 years back and check how many assets were there with the amalgamating company. Of that, at least 75% of the book value of the asset should be there even today. Okay. If it is there today, then you are fulfilling these conditions, or else you are not fulfilling this condition. The example is given below. You can see that. Okay. Now next page, amalgamated company has to fulfill 3 conditions. Amalgamating has to fulfill 2. Amalgamated has to fulfill 3. Which are the 3 conditions? First, the amalgamated company should continue the business for at least 5 years. It is not that you are buying the business and you are closing down in 1 or 2 years. No. If you are buying it, then you should at least continue for 5 years. Okay. Secondly, if the amalgamated company is an industrial undertaking like manufacturing etc. of goods or services, manufacturing of goods etc. or processing of goods, then they have to fulfill certain more prescribed conditions. What are those prescribed conditions? Listen carefully. For only industrial undertaking, there are some more conditions. This condition number 2, listen carefully, it's not for everybody. It is only for industrial undertakings, not for everybody. So what they are supposed to fulfill? They are supposed to fulfill few more conditions like whatever capacity they have received, production capacity. Say they have received a production capacity in amalgamation of 1 lakh units per year. They have to achieve at least 50% by the end of the 4 years. So by the end of the 4 year, they have to reach at least 50%, and in the 5th year, they have to maintain at least what? That much amount. Okay. So in the first year, suppose out of 1 lakh unit, you have reached to 20%. It's okay. Second year, 30%. Third year, 40%. And then 4th year, you have to reach at least 50% of the total capacity. So if you reach that much, this condition is fulfilled. Otherwise, you are violating the condition. Sir, can I get some relaxation over here? Yes, you can make an application to the government, and the government can relax the period also. The government can relax the level of percentage also, production also. Okay. They can relax it to 40%, 30%, or relaxing the period means they can increase the period from 5 years to 6 years or 7 years also if the situation justifies that. Okay. Next, point number 3, whatever assets the amalgamated company has got in amalgamation. In amalgamation, I have got lot of assets that I have to maintain with me for 5 years. At least 75% of the book value of the fixed assets should be there with me after 5 years also. Okay. So whatever assets I have got, I have to maintain those assets. I have to use those assets in business, and at least 75% of those assets should be there with me after 5 years also. Okay. Now, if I fulfill all these conditions, then the accumulated losses and the unabsorbed depreciation of the accumulated losses and the unabsorbed depreciation of the amalgamating company will be will be amalgamated company's loss, and it will be carried forward for another 8 years. It is not that it will be carried forward for balance number of years. It will be carried forward for how many years? For another 8 years. That is the biggest advantage over here. Sir, what does accumulated loss include, sir? Will it include all kind of losses? Don't be under a wrong impression. It will only include PGBP loss. That too, it will not be non-speculation loss. It is only a loss which is covered in section 72. Not all losses are covered. Only section 72 non-speculation PGBP losses will be covered, which will be carried forward by the amalgamated company for another 8 years, and unabsorbed depreciation can be carried forward for infinity. Okay. Now, what is the deemed income concept over here? If you violate any condition in future, like if you close down the business in 5 years, like if you don't fulfill the conditions of prescribed conditions of industrial undertaking, like if you don't maintain 75% of the assets after 5 years, then whatever set off was made earlier of losses or whatever set off of unabsorbed depreciation was made earlier shall be deemed to be your income of the previous year in which you violate the condition. Okay. It will be deemed to be your income. Now, let me again tell you the conditions which are mentioned in section 72A, which you just read, is only for carry forward and set off. It is not for claiming what? Please tell me. Exemption. For claiming exemption, you need to fulfill the condition which was there on the first page of amalgamation. That only is sufficient to claim the exemption. Yes, if you want to carry forward the losses, you have to fulfill all the conditions mentioned in section 72A also. Okay. Now, what is the treatment in the hands of amalgamated company? Just imagine yourself as an amalgamated company. What has happened with you? You have received lot of assets from the amalgamating company, right? You have received lot of assets. Now, later on when you sell these assets, whether you will be liable for capital gains or not? Yes, the answer is yes. So what will be the cost of acquisition in your hands? The cost will be the cost to the previous company. That is the cost to the amalgamating company. Whatever is the cost to the amalgamating company, that will become your cost, and the period of holding will be clubbed in your hands. Okay. Now I have put over here the entire discussion of PGBP and other relevant provisions which are relevant with what? Which are relevant with amalgamation. I will discuss all of them with all of you. Now, the first one is section 35. If there is an amalgamation of scientific research companies, then if the scientific research asset is transferred, okay, even a scientific research asset can be transferred, that is also not subject to tax. Okay, don't worry. Then unabsorbed capital expenditure of scientific research. Do you remember that is treated as UID? Then that can also be treated as UID over here. You can claim that also, and you can carry for that also. Later on, if the amalgamated company sells the asset which is received in amalgamation, the amalgamated company will be liable for deemed income, whatever was there under the chapter of PGBP. Okay. Similarly, telecom license fees paid 35 ABB or spectrum license fees paid 35 ABA, where a license is transferred by amalgamating company to amalgamated company, that is also not a taxable transfer. That is also exempt under income tax law. Deduction will be allowed to the amalgamated company. Don't worry, because we all know that in case of telecom license, the deduction is allowed over the life of the license. Suppose if the life is not expired, then the balance number of years can be allowed to whom? To the amalgamated company. Later on, if the amalgamated company sells the license, they have to bear what? The loss and whatever it is. Okay. Treatment of preliminary expenses. Yes, it will be given to the amalgamated company, whatever is the balance number of years. Okay. Treatment of amalgamation expenses also allowed in 5 years. that will be given to the amalgamated company. Treatment of capital expenditure of family planning. Capital expenditure of family planning is also allowed in 5 years. It will be given to the amalgamated company. Amortization of VRS expense is also allowed in 5 years. That is also given to the balance number of years will be given to the amalgamated company. Taxation of mines 10 years. Balance number of years will be given to the amalgamated company. Bad debts, if the goods were sold by the amalgamating company, but it is what become bad in the hands of amalgamated company, then I've already told in PGBP as per TV, the Bhadra Rao, K. Koteshwara Rao, it will be allowed to the amalgamated company. Recovery of expense will be taxable under section 41. If the expense was claimed by amalgamating company and it is recovered by amalgamated company, it is taxable in the hands of amalgamated company. But do you remember, I've told you in PGBP revision also, if the bad debts is claimed by amalgamating company and if it is recovered by the amalgamated company, then that is not taxable as per the Supreme Court judgment of P.K. Kamal. Last but not least, amalgamation of will have great impact on depreciation also, which we have done in PGBP also, that in case of amalgamation, compute depreciation as if no amalgamation has taken place and then apportion between both of them on the basis of number of days the assets are used by them. Remember or not? And last but not least, that in case of amalgamation, whatever depreciable assets are coming to us, that for that the WDV in the hands of the previous owner will become what? The actual cost in the hands of the successor, that is amalgamated company. Now, there is a special point which I am mentioning over here for point number 5, 6, 7, 8, 9, 10. What is point number 5, 6, 7, 8, 9, 10? If you have a deep understanding of these points, point number 5, 6, 7, 8, 9, 10 are nothing but all amortizations. Okay, from 5 to 10, all of them are amortization. So the question is, in the year of amalgamation, who will claim the deduction? See, before amalgamation, previous year till last year, amalgamating company will claim. In future, amalgamated company will claim. But who will claim in the year of amalgamation? Are you clear? So the law says that all these expenses in the year of amalgamation will be entirely claimed by the amalgamated company. It will not be bifurcated between both of them on any ratio. Is it clear to all of you? Please tell me. So let's go ahead with the next point, and that is section 43C, which is a very small section with respect to amalgamation only. What is happening in this section? For example, you are an amalgamating company and I am an amalgamated company, and you are giving me some assets in the amalgamation. You are amalgamating, I am amalgamated company, you are giving me some assets under amalgamation, and later on I am selling that asset as an SIT. How I am selling? I am not selling those assets as a capital asset, but rather I am selling those assets as what? As a stock in trade. Then what will be my actual cost of that particular SIT? It is nothing but it is the cost of acquisition to the amalgamating company plus cost of improvement to the amalgamating company. Whatever cost amalgamating company has incurred, that will become my cost of acquisition. Is it clear? I hope it is clear. Similarly, this point is also applicable for partition of HUF. If an HUF is partitioned and the partitioned HUF is giving some assets to the members, then also this provision is applicable. This point is also applicable for gift, will, irrevocable trust, later on sold as what? SIT. Okay. For example, I am giving you something as a gift, as a capital asset, but later on you are selling that as what? As an SIT. So what will be the cost of that SIT in your hands? The cost of that SIT will be the cost in my hands. The cost in the hands of predecessor will become the cost in the hands of the successor as per the provisions of section 43C. Now we will move ahead with, we have started with what? Section 47 just some time before. So we will continue with the discussion of section 47 first of all today, and then we'll go ahead with some other provisions of the capital gains. Section 47(9), what does it talks about? 47(9) talks about if you give some work of art, if you sell some, if you transfer some work of art or archaeological collection or scientific or art collection or book or manuscript or drawing or painting, photography, print, to whom? If you sell all these things, if you transfer all these things to government or university or national museum, national art gallery or archives or other notified institutions or public institutions, public museum as the case may be. So if you sell these specific items to governmental people or public museum or to national art gallery, etc., then capital gains is what? Please tell me. It is exempt. No capital gains will be charged on you. Is it clear, all of you? Please tell me. Next one is with respect to sovereign gold fund. What does sovereign gold fund has to say about in section 47(7)(c)? Sovereign gold fund, listen carefully. If it is transferred by an individual, on redemption means on maturity, then it is exempt. Sovereign gold bond is not liable for tax. But if it is transferred before redemption, then it is taxable, and if it is taxable, then indexation is available on sovereign gold bond. Okay. Now, what about others? What about if individual is not transferring? If an HUF is transferring or a company is transferring, then it is always taxable, whether you transfer before redemption or whether you transfer on redemption. The indexation will be available in both the cases. So only for individuals, it is exempt if it is transferred or redemption, In rest of the cases, it is taxable and it is subject to indexation. Okay. Next one is section 47(7)(b), which is absolutely dedicated to non-residents. Listen carefully. If one non-resident, listen to my fingers, see my fingers. If one non-resident transfers to another non-resident government security on which there is a periodic interest through an intermediary outside India, if you fulfill all these conditions, then it is exempt under income tax law. I will show you all the conditions. There is a government security which is transferred by NR to another NR on which there is a periodic interest. There is an intermediary and it is transferred where? It is transferred outside India, then it is exempt, exempt and exempt. Okay. Next one, next exemption in section 47, that is 47(10). If you convert your bonds or debentures or debenture stock or deposit certificate, these four items are getting converted into what? These four items are getting converted into shares or debentures of that company, then it is exempt. So if you convert these four items into shares and debentures of that company, it is exempt. So what will happen later on when they will sell those converted assets, converted shares? The cost of acquisition of the converted shares will be the cost of acquisition of the old bonds, old debentures, old debenture stock and old deposit certificate. Is it clear? And the period of holding will also be what? Will also be clubbed over here to determine whether the asset is what? Is long term or short term. The same is the case under section 47(10)(b). When you convert a preference shares into an equity shares, this is exempt under income tax law. No capital gains under section 47(10)(b). But at the same time, when you will later on sell the equity shares, the cost of the equity shares will become the cost of the preference shares. Period of holding will be clubbed. Is it clear, all of you? I hope it is clear to all of you. What about SIC company? If you are a SIC company, when a company can become a SIC company? A company is called a SIC company when the losses of the company is more than the net worth of the company. Then a company can be called as a SIC company. So if you are a SIC company and if you transfer land, being a SIC company, you are transferring some land, then that is not taxable under section 47(12). Okay. Next one, 47(16), reverse mortgage scheme. I am a senior citizen and if I am transferring some house property, my house, under reverse mortgage scheme, then that is exempt under section 47(16). In return, the bank will give me some installment or lump sum amount. That is also exempt under section what? 1043. The house which I am transferring, that is also exempt, and the lump sum or the installment which I am getting from the bank as a consideration for transferring, then that is also exempt under section 1043. Okay. Next, transfer of mutual fund units under consolidation scheme or consolidation plans of the mutual fund. For example, there are three mutual funds. One is mutual fund A, mutual fund B, mutual fund C. There are three schemes of mutual fund. How does the mutual fund hierarchy runs? There is a mutual fund company, for example, SBI mutual fund. In that, there will be three different schemes of mutual funds. And in the schemes, there will be further plans of mutual fund. What are the schemes of mutual fund? You can say growth scheme. You can say one is SBI FMCG scheme. You can say SBI equity scheme. You can say SBI banking scheme. These are different kind of schemes. And in every scheme, there will be further plans, which are called as dividend plan, growth plan, dividend reinvestment plan. So if you do a merger of these plans, okay, or if you do a merger of what? These schemes, then just like amalgamation, I am a unit holder of a mutual fund company. Now that mutual fund company is getting merged with another mutual fund company. Okay, it is getting merged with another scheme or it is getting merged with another plan. So what will happen to my units? I have to give the units of the old company and I have to take the units of the new company. The old company is called as consolidating scheme or consolidating plan, and the new company is called as consolidated scheme and consolidated plan. So what are you supposed to do as an investor? If you want exemption, if you want to enjoy the exemption, give the units of the consolidating scheme, give the units of the consolidating plan, take the units of the consolidating scheme, consolidated scheme and plan, your capital gains will be exempt. Later on, when I will sell the units of the new scheme, the cost will be the cost to the previous unit. Whatever was the cost of the consolidating scheme, that will become the cost over here. Period of holding will be clubbed. It is exactly similar to what? Which is there under amalgamation. Nothing new. Okay. Next one. If an Indian company is issuing some rupee denominated bonds and if the non-resident is transferring, if one NR is transferring the rupee denominated bond of Indian company to another NR outside India, then it is exempt under section 47(7)(a). So NR should transfer to NR, rupee denominated bond should be transferred, and outside India it should be transferred. It is exempt under income tax law. And there is one more relaxation over here. But what if that NR transfers the rupee denominated bond back to the company on redemption? Then that is not exempt. Okay, then that is not exempt. That is not exempt. When one NR gives the rupee denominated bond to another NR, that is exempt. But one NR gives that rupee denominated bond back to the company on redemption and takes the money back from the company, that is not exempt. There only if there is some currency gain because of appreciation of rupee, if there is some currency exchange, then that gain only will be what? Will be exempt under the income tax law. For example, today on the date of issue of bond, $1 is equal to 100 rupees. Okay. Now, after 10 years on redemption, if $1 is equal to 50 rupees, there is an appreciation of rupee. Now, because of the appreciation of rupee on redemption, there might be what? There might be some kind of currency gain which will happen in this transaction. So, that currency gain is what? Exempted by the government of India. Is it clear, all of you? I hope it is clear to all of you. Next one, 47(7)(ab), some hardcore provisions with respect to non-residents. Okay. First of all, section 47(7)(ab). What does it talk about? Pay attention, please. There is an NR. There is an NR who is transferring some capital assets. Who is transferring some capital assets through a recognized stock exchange in IFSC. NR is transferring some capital assets through a recognized stock exchange in IFSC, and the consideration is payable in foreign currency. Then it is exempt. Which are those lucky capital assets? Which are those fortunate capital assets? The list is as follows. It is bond, it is global depository receipts referred to in 115AC, it is rupee denominated bond of Indian company, it is derivative and such other security as the government may notify. Has the government notified any of them? Yes, they have notified 4 securities as you can see below. Foreign currency denominated bond, unit of mutual fund, business trust or alternative investment fund, foreign currency denominated bond, denominated equity shares of a company or bullion depository receipts with underlying bullion. So if these assets are transferred by whom? By an NR. Where it is transferred? Through a recognized stock exchange. Where is the recognized stock exchange? In an IFSC. How is the consideration payable? In foreign currency. Then it is exempt under the income tax law. Is it clear, all of you? Please tell me. I hope it is clear to all of you. Then next, coming to section 10(4)(d). 10(4)(d) is an exemption which is given under section 10. Now what is the exemption over here? Here the exemption is given to certain specified fund. Sir, what do I mean by the term specified fund? I will come to that in a while. Before that, I would like to tell you which incomes are exempt of a specified fund. I will come to the definition of specified fund also in a while. Before that, I'll tell you which incomes are exempt. First of all those capital assets which are mentioned in 47(7)(ab), that is all these assets are exempt for specified funds also. Are you clear? For specified funds also it is exempt. Same condition. If it is transferred through a recognized stock exchange which is located in IFSC and the consideration is payable in what? In foreign currency. Second, if there is a transfer of security, of which company? Other than resident company security, not of resident company, then that is also taxable over here. Third one, the first 2 incomes are with respect to transfer. If the income is with respect to transfer, it means it is a capital gain income, correct or not? The third one is not a transfer income. It is any income from security. It is any income from securitization trust. So it has to be other income like interest income, dividend income, PGBP income. It is not your capital gain income. Okay. So this income is which income? This income is your interest income or dividend income. Okay. Be very careful. So therefore, which income is exempt over here? Be very careful. Any income, this income is either interest or dividend. This is not capital gains income. Any income from securities issued by NR. If an NR is issuing some security, what kind of NR? Not being a PE of a non-resident in India. That NR should not have what? A permanent establishment in India. It means the security is issued by an NR which is located outside India. It is not located in India. Okay. And the last income over here which is taxable over, which is exempt over here is income which is coming from securitization trust. You are investing some money in securitization trust and securitization trust is distributing you some income that is chargeable under the head PGBP. These are the 4 incomes which are exempt for specified fund. Still, I have not told you who are specified fund. I will tell you who are specified fund in a while. Okay. Now, what do I mean by the term specified fund? I will come to that in a while. Now, let me talk about that first. There are 2 types of specified fund over here. One is mentioned in point number A. Another is mentioned in point number B over here. I'll show you. Another one is mentioned in point number B. Let me talk about the point number A specified fund. It's a long section. You have to be very careful and you have to be very patient with me. First of all, who is a specified fund, sir? It is the fund, point number A specified fund. Then I will go to point number B specified fund. Point number A specified fund. It is a fund established or incorporated where? In India. It is incorporated in India. In what form? In the form of a trust, company, LLP or body corporate. Now, which has a category 3 AIF certificate. Which certificate? Category 3 AIF certificate. And that that investment fund has to be located where? Inside the IFSC. And all the units of that fund has to be held by whom? By the non-resident, except other than the sponsor and the manager. And the sponsor and the manager can be residents. Those are allowed to be resident. Apart from the sponsor and the manager of the fund, everybody has to be what? Everybody has to be non-resident, non-resident, non-resident. Now, be very careful. It is a fund established in India in the form of trust, company, LLP, body corporate. It has a certificate of category 3 AIF. It is located in IFSC. All the unit holders are outsiders, non-resident. Only the sponsor and the manager are residents in India. Okay. Now, for the third condition, there are some relaxations which are given by the government of India. What is the third condition? All the units are held by whom? Non-resident, non-resident and non-resident. Now, there are some relaxations given in condition number 3. Condition number 3 shall not apply where any unit holder was non-resident during the previous year, but he becomes resident in any subsequent year. So, in the year in which the units were issued, suppose the units were issued in 23-24, in that year the unit holder is non-resident, but in subsequent year he becomes what? Please tell me. Resident. So, it is allowed. But that is only allowed to the extent of how much percentage? Please tell me. Only 5% of value and units. Only 5% of value and units. And those shareholders who are what? Becoming what? Resident in subsequent years. Who are becoming resident in subsequent year, they should exit the fund within 3 months from the end of the previous year in which become resident. They should become resident and then sell off the shares and exit the market. Are you clear? I hope it is clear to all of you. This is the first specified fund. Let me talk about the second specified fund. In between, whatever is the data I'm trying to explain you, don't worry. What is second specified fund? Second specified fund is investment division of an offshore banking unit. Sir, what is investment division of an offshore banking unit? It is nothing but an investment division of a non-resident bank which is located in IFSC. Suppose Standard Chartered, who is a non-resident bank, they have every bank has an investment division because they have to invest at multiple places their money. They have a lot of money where to invest. They have, for that purpose, they have an investment division. So Standard Chartered, Citibank, they have an investment division which is located in where? In IFSC. That can be called as what? Investment division of what? Offshore bank. Only an investment division of a non-resident bank which is located in IFSC, that can be qualified as investment division of an offshore bank. Is it clear or not? Please tell me. Which has been granted what? A registration of category 1 foreign portfolio investor, and they have to fulfill some more conditions which the government has prescribed. I'll show you which are those conditions in a while which the government has prescribed. Okay. Now, one very important point which I would like to address you all. Coming back to the main section, section 10(4)(d). What does 10(4)(d) says that? 10(4)(d) says that this income. Which are these incomes? Some of them are capital gains income, some of them are interest dividend income, some of them are PGBP income. Now, the government says that only that much income will be exempt which is attributable to the units held by the non-resident. It is not fully exempt. Okay. Only that much income will be exempt which is attributable to the non-resident. So how to determine that? For that purpose, how much income is exempt? You have to use this formula. Check this please. Whatever is the dividend or income which is earned multiplied by asset under management held by the non-resident divided by asset under management held by all the unit holders. This will give you what? That proportion of dividend income which is held by which unit holders? Please tell me. Non-resident. Only that much will be exempt. Only that much capital gains will be exempt. Only that much dividend income will be exempt. Are you clear? Please tell me. The rest of the income will be taxable. Similarly, if I come to the second specified fund, here also there was some condition that may be prescribed by the department. Can you see this? Which will be prescribed, which was written over here. So has the government prescribed some conditions? Yes, they have prescribed some conditions over here which we have to see over here. Which are those conditions? That you have to maintain separate account for the investment division. Apart from the separate accounts, the accounts must be audited by the chartered accountant. Okay. Separate account has to be made for that investment division of offshore banking unit. Separate account should be audited by a chartered accountant. They have to maintain proper documentations of what? Inward remittance, outward remittance, how much money is coming to India, how much money is going out of India, okay? How much money is used for the purpose of investment. They have to maintain all the bank statements. They have to maintain all the contract notes. They have to maintain what? All the statement of security issued by the custodian. These are certain formalities which they have to follow if they want to claim what? Exemption under the income tax law. Okay. Now moving ahead toward the next provision, which is also very recently inserted provision. In last 1 or 2 years, government has introduced this particular provision also. So what is this provision all about? Let me talk about this provision in a great detail. There is one fund, original fund. There is one fund, resulting fund. Let me give you a brief idea about both of them. An original fund is outside India. The resulting fund is in India. Listen carefully, see here. Original fund is outside India. Resulting fund is in India. they want to close that original fund and they want to shift all the assets. They want to shift all the unit holders where? Please tell me. In the India. That is in the Indian entity. That is in the country of India. So they want to close down. The government is encouraging you to close down the foreign funds and they are encouraging you to shift those foreign funds into what? India. They want the unit holders also to come to what? To invest in India. Okay. So this is called as relocation of capital asset by whom? By original fund to resulting fund. Now there are two tax implications which can come over here. Both of them are exempt under the income tax law. The government has said that whatever capital assets which are transferred by original fund to resulting fund is exempt under income tax law. Okay. Similarly, the unit holders or the shareholders of the original fund will transfer back the shares, will transfer back the units and will take the units in what? Please tell me. Will take the units in the resulting fund, just like amalgamation. Now in all these things, we need to understand what do you mean by the term original fund and the resulting fund. Okay. Now original fund is defined over here, but in this original fund, till last year, only one point was there. But now in Finance Act 2023, they have added two more points in original fund. Okay. I hope it is clear to all of you. Then there is a resulting fund over here, which we will talk about in a while. Okay. First, let me talk about original fund. Sir, what is an original fund? Now there are 3 points in original fund. Point A, point B and C is added by Finance Act 2023. Okay. Now, original fund, point number 1. It is a fund established outside India. Okay. What does it do? It collects funds from the members. For what purpose? For the purpose of investing, obviously. Okay. Now, currently the fund is where? The fund is outside India. The original fund is outside India. So it is not a person resident in India. It's a non-resident in India. Similarly, it should be of a country or specified territory with which India has DTAA. So the fund should be in such countries with which India has what? DTAA. Otherwise, it cannot be qualified as what? As an original fund. Third, the fund should be in such country where there is some protection regulations like SEBI in India. The way SEBI regulates companies in India, funds in India, the same way their country should also have some kind of companies with some kind of regulatory authorities which is located in their country. Okay. The fourth one is they should fulfill such other condition as may be prescribed. Okay, fine. Now that such other condition is same as what we have done earlier for the previous one also, that 5% etc. resident etc. That same condition which was there above 947 7AB 104D. Same condition is over here. Now, what are the 2 points which are added by Finance Act 2023? First one, there are 2 more original funds which can close their funds and come to India. First is investment vehicle in which Abu Dhabi Investment Authority is direct or indirect sole shareholder or unit holder or the beneficiary or interest holder, and such investment vehicle is wholly and owned by the government of Abu Dhabi. Okay. So there is an entity which is there in Abu Dhabi which is controlled by the government of Abu Dhabi. The government wants to close that and the government wants that they should come to India. Okay. And the third one is they have notified that they will notify few more institutions like this through a notification in a central government. Okay. Now, what is a resulting fund? What do I mean by a resulting fund? Let's see. A resulting fund is a fund which is established in India. It is established in India. It is in the form of a trust, company, LLP, and which has been granted with category 1, category 2, category 3 AIF. Okay. And it is located where? It is located in what? IFSC. So moral of the story, we want to close down the foreign funds and we want to bring their money to what? In India, and in India also specifically where? Please tell me. In the IFSC location. Okay. Not in the entire India. Okay. Last 1 or 2 points which I would like to address over here before we move ahead with the next point. Pay attention please. There are a few more small points over here. Let me address you all of them one by one. First one is section 47(7)(a). There is a transfer of capital asset. By whom? By an India Infrastructure Finance Company Limited. This is a transferor. Who is a transferor? India Infrastructure Finance Company Limited. They are transferring the assets to whom? To an institution established for financing the infrastructure and development which is set up under the parliament. Okay. So who is the transferor? India Infrastructure Finance Limited, and they are transferring to whom? To an institution which is established under the parliament law. Okay. Similarly, there is another transferor over here who is transferring some asset. Who is this transferor? This transferor is a public sector company who is transferring some assets to another notified public sector company, or it is transferring to central government or state government. So who is the transferor? Public sector company. Who is the transferee? Notified public sector company or central government or state government. Okay. Then also it is what? It is exempt, exempt and exempt. Okay. Now, one last thing is an absolutely new section 4720 and 49(2)(ai), which is inserted by Finance Act 2023. Okay. Now, what is this all about? Suppose, let me give you an example. By virtue of this amendment, any transfer of a capital asset, any transfer of a being an interest in the joint venture held by a public sector company. So there is a public sector company who is having some interest in what? in the joint venture. Okay, so I am say a public sector company, Steel Authority of India. I have some interest in what? In a joint venture. Okay, so I am transferring that interest. To whom? To a foreign company. Okay, to a foreign company. So I am Steel Authority of India. I have some interest in a joint venture. So I am transferring that interest to a joint venture to whom? To a foreign company. In exchange of what? In exchange of what? In exchange of shares of that foreign company. Are you clear? So what am I giving? I am giving the interest in joint venture, and in return I am taking the shares of the foreign company. Is it clear? So that is exempt under capital gains. Later on, whenever I will sell the shares of that foreign company, what will I sell? Because now I have the shares of the foreign company. Whenever I will sell the shares of the foreign company, the cost of acquisition of the shares will become what? The cost of the interest in the joint venture. Are you clear? Whatever was the cost of interest in the joint venture, that will become the cost of acquisition of the foreign company shares. Is it clear? I hope it is clear to all of you. Let's move ahead to some more section 47 important provisions. Section 47(13) and section 47(14). What is the difference between the two? There is a very minute difference between the two. In section 47(13), a firm is getting converted into a company, and in 47(14), a sole proprietor is getting converted into a company. Okay, so if a firm is converted into a company, or if a sole proprietor is converted into a company, there are a lot of exemptions you are going to get under capital gains. No capital gains is chargeable on transfer of assets from the old partnership firm to a new company, or no capital gains will be chargeable if an asset is transferred from a sole proprietor to a company, subject to some conditions. What are those conditions? This is only allowable in case of a succession of a business. This is not allowed in case of succession of a profession. And then 4 conditions should be fulfilled. First, all assets and liabilities of the firm should be transferred. All the partners should become the shareholder in the same ratio in which their capital account stood. They should become the shareholder in the ratio of the capital account. Be very careful. Third, the partner should not receive any consideration other than the shares. Fourth, the aggregate shareholding of the partner should not be less than 50%, and it should be maintained for a period of 5 years from the date of succession. Okay, for how many years it has to be maintained? For 5 years from the date of succession. The same provisions are applicable when a sole proprietor is converted into a company, except that condition number B will not be applicable to sole proprietor. Rest all conditions are applicable to sole proprietor also. Here also section 72A, carry forward and set off of loss is applicable. Whatever is the loss of the partnership firm or sole proprietor, that can be carried forward by the company. Which loss? Only section 72 loss, not all losses. Remember or not? Only section 72 loss and unabsorbed depreciation can be carried forward for another 8 years. Okay. Now later on, if you violate any of the conditions, like if you do not hold the 50% equity shares for a period of how many years? For a period of 5 years, then whatever capital gains was exempt earlier, that will be deemed to be chargeable under the income tax law. Okay. Then I have told you some of the points which is mentioned below. First is, this section is not applicable for profession. If there is a succession of a profession, it will be taxable. That is not exempt. Secondly, if the partners have negative capital, then how will the ratio be decided? Because one of the condition is that all the partners will become shareholder in the ratio in which their capital account stood, right? So what if the partner's capital is negative? If the partner's capital is negative, tell the partners to bring the capital and make it positive. Okay, I hope it is clear to all of you. What if the business profits are transferred? What if the stock in trade is transferred? Is that also exempt? No. Stock in trade is not exempt. Stock in trade, if it is transferred by a predecessor to a successor, then that is taxable under the income tax law. Okay, I hope it is clear to all of you. Similarly, there is one more conversion over here which is covered in section 47(13)(b). Sir, what is this conversion? This is the conversion of an unlisted company or a private company into an LLP. So if an unlisted company or a private company is converted into LLP, there are 2 kinds of exemption. First of all the assets which are transferred from here to there are exempt. Second, the shareholders will transfer the shares, correct? Shareholders will transfer the shares of the unlisted company or private company, and in return they will take what? They will take the share in the LLP. That is also exempt under the income tax law. Now, how many conditions to be fulfilled if you want to claim these exemptions? There are 7 conditions that you have to fulfill, out of which 4 are same only the previous one. That is first one. All the assets and liabilities are to be transferred, which was same as the previous one. All the shareholders should become what? Should become the partner in the LLP, and their capital contribution and the PSR should be in the ratio of shareholding. Okay. Third one, the partners should not receive any consideration other than the share of profit. Okay. And the fourth one, the aggregate profit sharing of all the partners should be at least 50%, should not be less than 50%, and it should be maintained for a period of 5 years. The first four conditions are similar only to the previous provision. The fifth, sixth and seventh condition is a new condition. Fifth condition, the turnover or the sale of the company in the last 3 years should not exceed 60 lakh rupees. In any of the 3 years, it should not be 60 lakhs. If in any of the 3 years it is more than 60 lakhs, this condition is violated. Okay. The total book value of the assets of the company in any of the 3 years does not exceed 5 crores. It should not exceed 5 crore even for a moment. Okay. And the third one, the partners are not paid anything from the balance of the company's P&L. The company is getting converted into what? Into an LLP. The company has profit and loss account. It might have some money inside that. The partner should not be paid anything out of that for a period of how many years? Please tell me. For a period of 3 years, 3 years, 3 years. Later on, whenever the LLP will sell the assets, the cost in the hands of the LLP will be cost to the previous owner. Period of holding will be clubbed. If later on any conditions are violated, whatever capital gains was exempt earlier will be subject to what? Please tell me. Will be subject to taxable. Okay. Then, sir, if a company is getting converted into an LLP, what about the MAT credit of the company? Can the MAT credit will also be carried forward? No, the MAT credit of the company will be lapsed. That cannot be given to what? The LLP. The MAT credit will be lapsed under the income tax law. Section 72A is applicable here also. It means if there are unabsorbed depreciation or if there is business loss, that can be carried forward by the LLP for another 8 years. Is it clear, all of you? Please tell me. Next one is also another conversion, where an AOP BOI, which was a stock exchange earlier, an AOP BOI, which was a stock exchange earlier, got converted into a company. Generally, every stock exchange initially forms an AOP BOI, and then later on it gets converts into what? A companies. Okay. So if I want to become a part of that stock exchange initially, say for example, in 1970s, we opened one stock exchange, Bombay Stock Exchange, and I am a member of that stock exchange. Now, initially it is an association of person or body of individual. How will I become the member of that particular stock exchange? I have to buy the membership right of that particular stock exchange. Then I will become the member of that particular stock exchange. For example, in 1970, there was an AOP BOI, which is a stock exchange. I bought the membership rights of that particular stock exchange for 1 lakh rupees, for example. Now, in 2015, they are converting that AOP BOI into what? Into a company. So, if an AOP BOI, which is a stock exchange, is getting converted into a company, then it is exempt under income tax law, provided two conditions are fulfilled. First, all the assets and liabilities of the AOP BOI should be transferred to the company, and such approval, such conversion should be approved by the Securities Board of Exchange of India. Okay, Securities Exchange Board of India should approve such conversion. If these two conditions are fulfilled, whatever assets are transferred by AOP to the company is exempt. And what about the member? The member will return the membership right. What will the member do? Member will return the membership right, and in return he will get two things. First, he will get the shares of equity shares in the new company. Second, he will get trading and clearing rights. Okay, so he will get two things. So if he returns back the membership right, and in return he takes what? Shares and trading and clearing rights, then that is also exempt under the income tax law. So later on, when he will sell the shares, what will be the cost? The cost of the equity shares will become the cost of the original membership. Whatever was the cost of the original membership, that is 1 lakh rupees, that will become the cost of the shares, and the option to take FMBS on 1/4/2001 is not available over here, even if you have acquired before 2001. Second, then what will be the cost of trading and clearing rights? The cost of the trading and clearing rights will become what? Will become nil, because you have already taken the cost of acquisition as deduction over here. Okay, so period of holding that you can club, etc., etc. That is something which is very simple. Last but not least, if there are some depreciable assets which were there with AOP and now that is transferred to whom? That is transferred to the new company. The WDV in the hands of the AOP will become what? The cost in the hands of the what? In the new company. Okay, let us move on to the next chapter, which talks about the cost of acquisition of assets declared under the income declaration scheme. Okay, in 2016, the government has brought one income disclosure scheme. Income disclosure scheme, you have to disclose your income, you have to disclose your asset, you have to pay 45% tax, and then you have to relax. Okay, so all those who have paid 45% tax, no queries will be asked to them regarding their taxation. Are you clear? Say for example, so I disclosed one asset of 100 crore rupees, okay, which I have not disclosed earlier. So I can go to the department and I can disclose the assets. In 2016 it is there, right now it is not there. So in 2016 I went to the department and I disclosed the asset of 100 crore rupees. After I disclose the asset of 100 crore rupees, I have to pay 45% tax. How the tax is determined? 30% of the asset value will be the tax plus 25% Krishi Kalyan cess and 25% your penalty. The totaling to what? 45% of the FMV of the asset. So whatever asset, how much asset I have declared? 100 crore value asset I have declared. Pay 45 crore tax and then you relax. Nobody will ask you any question. No penalty, no interest, nothing extra. Now the question is, when I will sell this asset later on, which I have disclosed under the income disclosure scheme, what will be the cost of that asset? The cost of that asset will become 100 crore. Is it clear? Whatever is the FMV, that will become the cost of that asset. Okay. Now the second question, from when I will count the period of holding? The period of holding depends upon two things, whether your asset is immovable property or other. If your asset is immovable property and if you have a proof of purchase, okay, there is an evidence of your deed, that is, this is the date of purchase, okay. If you have acquired an immovable property, it is a black property. Obviously, you are disclosing under what? Income disclosure scheme. It's a black property and you are having a proof of that I have purchased in 2005. Then you can count from 2005 the period of holding. But if you don't have the proof, or in case of any other asset, jewelry, diamond, whatever it is, in that case, the period of holding will be counted from where? Please tell me. 1st of June 2016 only. Next one, forfeiture of advance. Suppose you are trying to sell your asset to somebody, but the negotiation did not work and it did not happen. It fruitfully does not happen. And therefore, you have taken some advance from someone and now you have forfeited that advance. Okay. You are about to sell your property. You took some 1 lakh rupees advance. Now the transfer cannot happen because of the non-negotiation. Now I am not refunding that advance to the other person. So what is the treatment of that advance which I have taken from the potential buyer? That advance depends upon when you have forfeited. If it is forfeited before 1/4/2014, okay. If it is forfeited before 1/4/2014, then you have to reduce it from the cost of acquisition whenever you will sell the asset, okay. But if it is forfeited on or after 1/4/2014, then you have to do what? You have to take it as income from other source. Is it clear, all of you? Please tell me. So let's move on to the next provision, that is with respect to certain exemptions which are there under section 10 and then 111A and 112, okay. 112A. The first one is exemption under section 1033. If you transfer a unit of a unit scheme, then it is exempt under the income tax law. Unit of a unit scheme is exempt under income tax law, no income tax, okay. Second one is section 1037. What does section 1037 talks about? It talks about multiple things. If you are an individual HUF, listen carefully. If you are an individual HUF and if you have an urban agricultural land which is used as a capital asset, not as a stock in trade, and which is used by you for agriculture purpose or by your parents for at least 2 years prior to the date of transfer, okay. So it should be used for agriculture purpose either by you or by your parents for at least 2 years for agriculture purpose. And if such kind of asset is compulsorily acquired under the law, it is compulsorily acquired, then your original compensation, enhanced compensation, everything will be exempt, okay. What about sir, what if it is not compulsorily acquired but it is sold by me? If it is sold by you, then it is not covered under section 1037, okay. Then it will be covered, it may be exempt under section 54B later on if you reinvest into a new land within 2 years, okay. That we'll see in the chapter of capital gain exemption, okay. So if you want exemption over here, there has to be a compulsory acquisition of your urban agricultural land which was used by you or your parents for at least 2 years, okay. I hope it is clear to all of you. Next one is a specific exemption 1037A which has been made for formation of the new capital city for Andhra Pradesh, that is Amaravati. What is happening in Amaravati? What the government has planned for Amaravati? To 2nd June 2014 was the formation of what? Andhra Pradesh and Telangana, okay. That is the day on which the two states separated. Now, the government wants to make separate capital city for what? For the purpose of Andhra Pradesh, which was named as what? Proposed name was Amaravati. Now, in that case, the government want huge land for the purpose of building a smart city or a new capital city. So, the government is taking what? Land from people, and in return, the government is giving them what? Land pooling ownership certificate. Remember, the government is taking their land and in return, the government is giving them what? Land pooling ownership certificate. So, whenever you transfer a land or building under the land pooling scheme, that is exempt under income tax law, okay. Now, after this transaction, what do you have? You have land pooling ownership certificate, correct? Now, what is the use of that? You can transfer that land pooling ownership certificate also. If you transfer this land pooling ownership certificate, then that is also what? Please tell me, exempt under the income tax law. Is it clear? Third one, what will be the use of that if I don't transfer the LPOC? If you don't transfer the LPOC, you will get a reconstituted plot of land in the new city, okay. Now, whenever you will get the reconstituted plot of land in the new city, if you transfer that reconstituted plot within 2 years from the end of the financial year in which the possession was handed over to you. If you transfer that within 2 years, then that is also exempt under the income tax law. This new land is also exempt if you transfer within 2 years. It means this new land will be taxable if you transfer what? If you transfer, please tell me, after 2 years. So if you transfer after 2 years, this new land will be taxable, and the question will arise, what will be the cost of acquisition of this new land? The cost of acquisition of this new land will be whenever this 2 years expires now. Whenever this 2 years expires, see here please, at that time what was the stamp duty value? That stamp duty value will become what? Your cost of acquisition over here. Okay. For example, the government has given you possession in 2022 March. Okay. So when will your 2 years expire? 2 years will expire on 31st March 2024. So if you transfer before 31st March 2024, then it is exempt. But if you transfer after 31st March 2024, then it is taxable. Then the question is, what is the cost? The cost will be the stamp duty value on 31st March 2024. Is it clear? I hope it is clear to all of you. Now let's come to something very, very, very important. And what is that important provision? And that is 112A. We will talk about 112A first, and then we'll talk about 111A also. In 112A, which talks about long-term capital gains in respect of certain assets. Which are those assets? There are 4 assets over here. First is long-term equity shares. Second is long-term equity oriented mutual fund. Third is units of ULIP. ULIP units which are covered under 1010D, which I have already revised with you earlier. Okay. And the fourth one is units of business trust. Okay. So there are 4 kind of assets over here which are covered over here. One equity shares and others are equity oriented fund, units of ULIP and units of business trust. So if you want to come over here, you need to pay STT. When should I pay STT? In case of equity shares, the STT should be paid both on purchase and sale. Okay. In case of equity shares, the STT should be paid both on purchase as well as sale. But there are some exceptions for purchase. That is, if you have purchased the shares on or if you have purchased the shares before 1/10/2004. So if you have purchased the shares before October 2004, there is no need to pay STT on what? Please tell me. STT on what? On purchase. Plus there are some transactions like IPO, if the shares are purchased in IPO, if the shares are purchased in bonus issue, if the shares are purchased by non-resident through FDI or section 47 certain cases. In that case also, if you don't pay STT on purchase, it's okay. So by default, in case of equity shares, you have to pay STT on purchase, but there are 2 exceptions in which you don't pay. It's okay. Okay. On transfer, you have to pay STT. Okay. What about other assets? In case of equity oriented fund, units of ULIP, units of business trust, in these cases, you have to pay STT only on transfer. There is no need to pay STT on purchase. Okay. Now, one more thing. If your stock exchange is located in IFSC, then there is no need to pay STT at all, because in IFSC, if a stock exchange is located, STT is not applicable only. That is fully exempt, Even without paying STT, you can claim what? The benefit of 112A. Okay. If all these conditions are fulfilled, what is an advantage? The advantage is you will be chargeable at only 10% tax plus surcharge and cess if applicable, and that too in excess of 1 lakh rupees. 1 lakh rupees flat exemption to every kind of SSE. Individual, HUF, firm, AOP, BOI, company, LLP, resident, non-resident, foreign company. Everybody will get 1 lakh exemption, and on above 1 lakh, every year 1 lakh. Per year 1 lakh rupees exemption you will get, and above 1 lakh, you are going to pay tax at the rate of 10%. Okay. Sir, apart from that, will I also get the benefit of exemption, basic exemption limit of 2.5 lakh and 3 lakhs also? Yes. Resident individuals and HUF will also get the benefit of basic exemption limit along with this 1 lakh rupees. So resident individual HUFs will get the basic exemption limit also and 1 lakh also. Okay. That too, that is also available for 111A also and 112 also. In all the 3 sections, whether it is 111A, whether it is 112 or whether it is 112A, in all the 3 sections, resident individuals and HUF will get the basic exemption limit also from the special incomes. Okay. These are special incomes, but you can take the basic exemption limit also from these special incomes. Now, coming to the grandfathering clause. What if you have acquired the shares before February 2018? Before February 2018, if you have acquired the shares, then how will you determine the cost of that shares? For determining the cost of that shares, the government has given the following step. First step, you have to find out the actual cost. And then in step 2, you have to find out the lower of the 2 items. Which is 2 items? That is FMV of the shares on 31st Jan, compare with the full value of consideration. That is the price at which you have sold the shares, whichever is less. This will become your step number 2. Then compare that with step number 1. then whichever is higher will become your cost of acquisition. Is it clear? Now, how to determine the FMV as on 31st Jan? How to determine? For that, the government has given mechanism. That is, if your shares are quoted or if your units are quoted, then you have to take the highest price on 31st Jan. Whatever was the highest price of that share on 31st Jan, that will become the FMV on 31st Jan. Sir, what if the share was not traded on 31st Jan? Then take 30th Jan. Not traded on 30th Jan, then take 29th Jan, 20th Jan, 27th Jan, 20. Some or the other day it would have been traded now. Take the value of that date. Okay. What if the units are not listed? Units are unlisted. If the units are not listed, then take the net asset value of the unit on 31st Jan. Okay. What if the shares are not listed on 31st Jan? If the shares are not listed on 31st Jan, then you have to follow this formula which is given on the board. That is, you take the cost of acquisition of the share multiplied by the cost inflation index of 2017-18, which is 272, divided by the cost inflation index of the year in which you have purchased the shares, or if you have purchased before 2001, then you have to take 100 in the denominator. Okay. So in case of unlisted shares, you have to index that to find out what the FMV is on 31st Jan 2018. Okay. Now some bad news and some good news. Many bad news and one good news. First bad news under 112A, no indexation benefit for 112A shares. It is not allowed. Indexation is not allowed for 112A shares. Second bad news, first proviso to section 48 is not applicable for 112A. So in case of 112A shares, you are not going to do that TTBR and TTSR and all those things, okay, which you have done in first proviso to section 48. Third bad news, no deduction of chapter 6A against 112A. Fourth bad news, no rebate against 112A income. Against 112A income, even if your income is up to 5 lakhs under old regime or up to 7 lakh in the new regime, you are not going to enjoy the rebate under 87A. The fifth one is a good news. If there is a loss under 112A, you can carry forward that loss and you can set off against your other long-term capital gains, okay? Because long-term capital loss can only set off against what? Can only set off against long-term capital gains. It cannot set off against short-term capital gains. 111A. What is 111A? It is similar to 112. How it is similar? Let me tell you. How it is different? Let me tell you. Your short-term capital gains is there. Their short-term, long-term capital gain was there. Here 15%. There 10%. Here there is no 1 lakh exemption. There is 1 lakh exemption. Okay. Here there is no need to pay STT on purchase. There is a need to pay what? STT on purchase. Okay. These are the only differences. Apart from that, there is no other difference. Sir, when I will sell the shares, whether it will be coming under PGBP or whether it will be coming under capital gains. See, that is a matter of great discussion. Whether it will be coming under PGBP or capital gains, that depends upon case to case. Okay. For that, CBDT has given a circular in which they have said that case to case basis, you have to decide whether your gain will come under capital gains or your gain will come under PGBP. You have to look into the facts and circumstance of every case. Now let's move on to the next point, and that is exemption under section 54 to 54GA. Sir, what is this all about? There are around 6 to 7 exemptions that we are going to talk about one by one. I will deal with the first one first of all, and then I will talk about the rest of them as a comparative analysis. The first one is section 54. What are you transferring in section 54? You are transferring a long-term residential house property. Okay, a long-term residential house property is transferred by you. Now, what should you do? You should purchase another residential house property. So, till when I should purchase? You can purchase 1 year before the date of transfer, or you can also purchase 2 years after the date of transfer, or you can construct 3 years after the date of transfer. Okay. So for purchase, you have the prior period also, you have post period also. For construction, you have post period. Okay. Sir, I have 2 years time to purchase now. Yes, sir. Sir, but due date of filing of return is coming in between. Don't worry. You can deposit the money in what? In the capital gain account scheme by the due date of filing of return, and you can enjoy the exemption. The best thing is you should purchase the new house by the due date of filing of return. But in case it is not possible, to purchase, then you can do one thing. You can make the payment in the capital gain account scheme till the due date of filing of return, and then you can withdraw the money later on and utilize for the purpose of what? Purchase of new house within 3 years, within 2 years purchase or 3 year construction. Now, if you don't do that, then it will become deemed income after what? After 3 years. Okay. Now that is 2 years for 54B. Why it is 2 years for 54B? You will come to know in a while. Okay. Now, Sir, I have deposited the money in capital gain account scheme and I will definitely withdraw the money and I will use that money to purchase the asset within 2 years, or I will use the money to construct the asset within 3 years, sir. But in case, sir, the assessee is dead in between, then what will happen with that amount in the hands of the legal heir? Legal heir is also liable to purchase a house? No. In the hands of legal heir, it is what? Please tell me. It is exempt in the hands of legal heir. Okay. Now, the next question is given in the next chart. Scheme of deposit was this. Next is, then how much amount is exempt? See, there are two categories of section. One category of sections is all sections except 54F, and in 54F there is a stricter way of giving the exemption. In all sections except 54F, you have to invest the gain. If you invest the gain, your full amount will be what? Please tell me. Exempt. Okay. But in 54F, you cannot invest the gain. You have to invest your full consideration. Your full net consideration has to be what? Invested. Then only it will be fully exempt. If you do not invest your full consideration and if you partly utilize your full consideration, suppose your net consideration is 1 crore and you have invested only 80 lakhs, then the exemption will be capital gains into cost of new asset upon net consideration. Only partial exemption will be allowed to you. Are you clear or not? In case of all sections, you invest only gain. But in case of 54F, you have to invest the entire net consideration. Are you clear? The provision is stricter over here. Then, sir, is there any lock-in period for the new asset? Yes. The new asset which you will purchase now, the new asset which you will purchase or the new asset which you will construct within 3 years, that should not be transferred for a period of 3 years. Okay. And in case of 54EC, it is further stricter time limit. 5-year time limit is there. 54EC, 5 years you cannot transfer. And in other sections, 3 years you cannot transfer. Sir, what will happen if I transfer within 3 years? What will happen? Then you have to pay 2 types of tax. One, the old capital gains which was exempt na, that will be reversed. Yes. And the new asset which is sold na, on that also you have to pay what? Capital gains. Is it clear or not? The old exemption will be reversed for violating the provision and the new capital gains will be charged for selling the asset. Sir, how will that be charged? So for that, the government has divided all the sections into 2 categories. All these sections like 54, 54B, 54D, 54G and 54GA, the treatment is different. And 54EC and 54F, the treatment is different. Sir, what is the treatment in the above mentioned sections? The treatment is as follows. You will write the full value of consideration of the new asset here. Okay. Whatever is the full value of consideration in the new asset, you will write down over here. Then you will reduce the transfer expenses. Then you will get what? Your net consideration. And from here, you will not reduce the cost of acquisition of the new asset. In fact, you will reduce the net cost of acquisition. How will you determine the next cost of acquisition? The cost of new asset minus whatever exemption was earlier allowed now. That much you will reduce from here and you will show net amount over here. Okay. I hope it is clear to all of you. Then the balance amount will be your long-term or short-term capital gain as the case may be. But in these 2 sections, you will not do net, but you will show separately. Are you clear? The cost of new asset will be written separately over here and the capital gains which is getting withdrawn will be written separately over here. Are you clear? So, sir, how will we remember that? For that, I have given you a hint in the class. If you are selling asset and if you are buying asset are of the same nature, that is residential property, land, building. If it is of the same nature, then you will follow the reduced cost approach which is given in the first table. But if the selling asset and the buying asset are of different nature, then you will follow the full cost approach which is given in the second table. Is it clear all of you? I hope it is clear to all of you. Now coming to this table, lock-in period I have told you. Last but not least, eligible assessee, individual HUF. Individual HUFs are eligible for section 54. Now I will compare the rest of the section. 54B, second section. What am I going to transfer in this? You will transfer urban agricultural land. Which land? Urban agricultural land, which was covered in 1037 also, if you remember some time before, which was compulsorily acquired by the government. Now here we are not compulsorily acquired, here we are transferring. Okay, here we are ourselves selling. Here it is not compulsorily acquired. So urban agricultural land, which is used by either me or my parents for at least 2 years for agriculture purpose. Now if whatever is the capital gains, if I want to exempt that capital gains, I need to buy another agricultural land. The new land which I will purchase, it may be rural, it may be urban, it doesn't matter. In how many years I am supposed to purchase? Within 2 years from the date of transfer I am supposed to purchase. The rest all points are same as what? Same as the previous section. Is it clear that you can deposit in capital gain account scheme? Then the amount of exemption will be the amount of capital gains. Within 3 years you cannot sell, etc, etc, etc. The third one is 54D. What is 54D? There is an industrial land and building which is used by me at least for 2 years for industrial purpose. Okay. So I have an industry in which I am using industrial land and building which I have used for at least 2 years. Now that is also compulsorily acquired by the government. Okay. Now, whatever is the gain on building, that will always be short term because that is a part of block. Okay, business building is always a part of block, na? Therefore, the gain will always be short term. Land, long term, short term, depending upon the period of holding. So, industrial land and building compulsorily acquired. I should buy another building, another land. Then my capital gains will be exempt. In how much time I should purchase or construct? You can purchase within 3 years or construct within 3 years. You have 3 years time. Rest all of them are more or less same only. Just at the end, it is written that this section is available to all the SSCs. Okay. Now coming to the fourth section, which is very important. 54 EC. What are you transferring in this section? In this section, you are transferring long-term land, long-term building. Long-term land, long-term building. Only land and building, that is long-term. And what are you buying? Within 6 months, you are supposed to buy. Within 6 months. And here, there is no option of what? Scheme of deposit. Scheme of deposit is not available in 54 EC. You have to buy within 6 months means you have to buy within 6 months. It is not that you will deposit in the scheme of deposit, then you can withdraw and then you will buy. No, you cannot do that. What am I supposed to buy? You are supposed to buy 4 things. Either buy NHAI bonds or RECL bonds or bonds of Power Finance Corporation Limited or buy bonds of Indian Railway Finance Corporation Limited. And here there is a limit of maximum 50 lakhs in a financial year. You cannot buy more than what? 50 lakhs in a financial year. Okay. I hope it is clear to all of you. Regarding this, there are some special points which I will be addressing in a while after some time. Okay. Now, 54F, the fifth section. What am I supposed to transfer? Transfer everything that you have long term. Everything that you have long term transfer except your house, except your residential property. Transfer everything that you have long term. And buy what? Buy a residential property. Is it clear? Transfer everything that you have long term and buy a residential property. Till when, sir? You can purchase 1 year before, or you can purchase 1 year, 2 year after, or you can construct within 3 years. Here the provision is stricter. To exempt your gain, what will you invest? Please tell me. You will invest the entire consideration, net consideration. If you don't invest the entire net consideration, then the gain will be exempt what? Proportionately. It will not be fully exempt. Okay? Be very careful. Next one, 54G. 54G, you are shifting your industry. From where? From urban area to rural area. And 54GA, you are shifting your industry from urban area to SEZ. This is the only difference between both of them. Rest all are same. So if you are shifting your industry from urban area or rural area, 54G will apply. From urban area to SEZ, 54GA will apply. What are you transferring? I am transferring land, building, plant, machinery except furniture. Land, building, plant, machinery except furniture. And what are you buying? Land, building, plant, machinery except furniture. Land, building, plant, machinery except furniture. Within how much time? Within 1 year before or 3 years after, I can buy these things. Then my capital gains will be what? Exempt, exempt and exempt. Now, there are certain special points that I would like to address you all one by one. First thing, in 54 EC, you will get maximum how much deduction? Please tell me. 50 lakh rupees in a financial year, not more than 50 lakhs. And in section 54 and in 54F, there are some now special points. In section 54 and in 54F, there is a condition that when you buy a house, you can only buy one house. Do you remember that or not? You can only buy one house. You cannot buy more than one house. But what if, in both the section, in 54 also, 54F also, but what if I buy two adjacent house and I break the wall? Will that be considered as one single house? The answer is yes. That can be considered as one single house. Okay. So if there are two adjacent house, I am breaking a wall, that can be considered as one single house under the income tax law. Okay. This is what it is written over here. Now, in 54, you get once in a lifetime option. In 54, not in 54F. In 54, not in 54F. In 54, what is the once in a lifetime option? That if your capital gain does not exceed 2 crore rupees. If your capital gain does not exceed 2 crore, you have once in a life option that you can take exemption of what? Please tell me. 2 residential houses in India also. But this is also once in a lifetime option. You cannot take this lifetime option once again once you opt it. Okay. So take it carefully. Now, some more points which are relevant to 54 and 54F. First one is relevant to 54. I sold one house and then I invested the capital gains in construction of a new floor of another house. So I have 2 houses. I sold one house. Whatever the amount came, I used that money to construct new floor in the existing house. Whether 54 exemption will be allowed, the department has said yes, you will be allowed that exemption. Okay. Second question was the construction should complete within 3 years, right? Everywhere it is written in 54 also, in 54F also, it is very clearly written that the construction should complete within 3 years. The question is, when should the construction start then? When it should start? When should start? It is not written in the law. The law only talks about that the construction should complete within 3 years. When it should start? It can start at any time. There is no starting time given by the law. Okay. Next one. If I have paid the money, I have taken the possession, everything is done, but the sale deed is not executed in my favor. Will I get the exemption or not? And the answer is yes. I have paid the money for new house. I have taken the possession also. I am staying in that new house. I have full control on the new house, but the house is not yet registered in my name. Will I get the exemption? The answer is yes. Okay. Now next one. I sold a house and I purchased another house in the name of my wife. Will I get the exemption of that particular house or not? I sold my house and I purchase a new house in my wife's name. Will I get the exemption? The answer is yes. The Delhi High Court has said that your wife is not a stranger. Okay. Therefore, you will get the exemption. Don't worry about it. Next one is with respect to only 54F, that if you want to claim exemption under 54F, there is one very important condition, that is on the date of transfer of long-term capital asset, you should not have more than one house. You should have either one house or you should have no house. If you have two or more houses, then the provisions of 54F is not available for you. Okay. Provisions of 54F is only available to who has only maximum one house or no house. Okay. Now there is an amendment made by Finance Act 2023 in section 54 and 54F. What do you purchase? In both the section we purchase a residential house, correct? And in both the section now the government has said that the maximum amount of exemption that we are going to give you is how much? Please tell me. The cost of the new house cannot be more than 10 crore. If it is more than 10 crore, the excess amount will not be considered for the purpose of calculation. Is it clear, all of you? Please tell me. Next one is 54EC and 54F special provision. This is with respect to a link with block of asset. Okay. Now inside a block, do you remember in case of block of asset, the gain is always short term? Yes or no? In case of block, the gain is short term. The asset is not short term in the block. The asset may be long term. The asset may be short term depending upon the period of holding. And what is written in 54EC? 54EC does not talk about the nature of gain. 54EC talks about the nature of asset. 54EC say that if the asset is long term, then you can enjoy the capital gain exemption under 54EC. So for example, I have a block of building in my business, and that is 10-year-old building. I'm selling that building. Is the building long term? The answer is yes. Is the gain short term? The answer is yes. Can I use that building gain to get exempt under 54EC? The answer is yes, because 54EC does not target the nature of gain. It talks about the nature of asset. Okay. Next one is with respect to 54EC. 54EC, as I have told you, in 54EC, the lock-in period is how many years? It is 5 years. In other sections, the lock-in period is how many years? 3 years. For 54EC, for 5 years, you cannot sell the bond, nor you should hypothecate the bond, nor you should keep the bond as a security and take a loan against that. Okay. That is also not allowed. And one last thing in the exemption over here, let me tell you, that is, suppose 5 years back, I have converted my capital asset into stock in trade. Okay. So 5 years back, I have converted my capital asset into stock in trade. Have I paid capital gain tax at that time? No, no, no. Capital gain tax is chargeable in the year in which you sell the SIT. So 6 months from the date of transfer should be counted from where? Where should I count the 6 months from? From the 5 years back or from the date of sale of SIT? The CBDT has issued a circular which says that the 6 months has to be counted from the date of sale of SIT, that is from today, and not from 5 years back. Check it, please. So let's go with the next part, and that is capital gains in case of block of asset. What will happen if you sell the block of asset of a capital gains which is covered in section 50? Now, first of all, you have to see whether you have sold the entire block or you have sold the part of the block. If you have sold the entire block, 100% there will be capital gain or loss, 100%. Then now you have to check what your net consideration with your opening WDV and purchase. If your net consideration is less, and your opening WDV and purchase is more, then there will be a short-term capital loss. Okay. And if the consideration is more, obviously if you are getting more and your cost and the WDV is less, then there is a short-term capital gains. Okay. So if you sell your entire block, then 100% capital gains will be chargeable on you. There is no doubt about it. What if the entire block is not transferred? Then you have to check whether the block is negative or not. The quantity column is not negative, right? The quantity column is not becoming zero because you're not transferring the entire block. Then you have to check the amount column. If the amount column becomes negative, when will the amount column become negative? If your consideration is more than your opening WDV on your purchase. Okay, if the consideration is more, opening WDV and purchase is 10 lakh and consideration is 15 lakh. So you will reduce 10 lakh minus 15 lakh, the amount will come to negative, correct? And therefore you will be liable for what? Short-term capital gains. But if your consideration is also less and your quantity is also there because you are not selling the entire block, then the question of capital gains will not arise. Then you will claim depreciation under what? Business and profession. Is it clear? I hope it is clear to all of you. Okay. Now, whether it is a short-term capital gain or long-term capital gain, always remember you will never get indexation in case of block of asset. Indexation benefit is denied forever. You will not get the benefit of indexation ever, ever, ever. Secondly, if your asset is a part of block and if it is destroyed due to fire, flood, and there is an insurance claim, then you have to reduce the insurance claim from the block of asset. Okay, from the block of asset you will reduce. Next. If there is a block of asset which you are about to sell to somebody, okay, now the negotiation did not work and you have taken some amount as an advance and now you are forfeiting that amount. Okay, so if you are forfeiting that amount before 1/4/2014, then you know what has to be done. It has to be reduced from what? The WDV from the block of asset. And if it is forfeited after 1/4/2014, then income from other source, as I have told you sometime before. Okay, next point I have already told you in the previous chapter, that is 54 EC exemption. That is the block of asset. Block of asset gain is short term. The asset might be long term. If the asset is long term, you can enjoy what? You can enjoy the exemption under section 54 EC. And the last point is very, very, very critical for you all for exam. Be very careful. This last point is absolutely important. I'll tell you the format of the block, how the format of the block runs. Opening WDV plus purchases less money payable. Less what? Money payable. It is not sale. The words used by the law is not sale. It is opening WDV plus purchases less money payable. What do I mean by money payable? Money payable means that asset on which there is some money payable. There is some amount which is payable by somebody to you. That is, if there is a sale, there is a money payable. If there is an insurance, there is a money payable by the insurance company. If there is a salvage, there is a compensation, there is a money payable by somebody. Now, for example, there is an asset in my block. Okay, there is one building in my block. Now that building is of no use to me. So I have discarded that building. I have done what? I have kept aside that building. We are not using that building for the purpose of business. We have discarded that building. Will I reduce that from the block of asset? The answer is no. Why? Because that building, on that building, there is no money payable as of now. Okay. Just discarding a building does not give you a right to reduce from the block of asset. So only discarding an asset will not be called as what? Money payable. Only if money is payable on that asset, you can reduce it from that particular block. This is a very important issue which has already come in exam a lot of times. Okay. Next one, I don't think so. Now it is very important for us to address these issues at this point of time. You all know that from 2020-21 onwards, you are not going to get the depreciation on goodwill. I hope you remember that, right? Goodwill depreciation is not allowed from 2020-21. So what are you supposed to do? On 1/4/2020, on 1/4/2020, whatever is the value of our intangible assets, whatever is your value of intangible assets, you have to remove what? Please tell me the WDV of the goodwill. Okay. So you have to make two calculations. Suppose you have purchased some assets in 2015. So from 2015 to 2020, one make consolidated WDV, find out goodwill plus other intangible assets. One separately only goodwill, find out the WDV. And whatever is the WDV of the goodwill, you reduce it from where? Please tell me. You reduce it from the block of asset. Okay. So that only and only which asset is pending in the intangible asset? Only other than intangible. Other than goodwill assets are pending in the intangible asset. Now, be very careful. Suppose the consolidated WDV comes to 10 lakh. How much it comes to? 10 lakh on 1/4/2020. And if the WDV of the goodwill comes to 15 lakhs, how much it comes to? It comes to 15 lakhs. How is it possible? I have given you examples in class if you remember. Go and check the examples. The consolidated value is 10 lakh, but the only value of goodwill is 15 lakhs. Okay. Goodwill and patent is 10 lakh and only goodwill is 15 lakh. Now when I will reduce 10 lakh minus 15 lakhs, that 5 lakh will be considered as what? Please tell me. It will be considered as a short-term capital gains if you remember. Okay. In the year 2020-21. But I personally don't think so. It is important because this transaction was important in 2020-21. This is not relevant now in 2023-24. I have listed down few things over here for your ease of understanding. The cases where indexation is not available. Indexation is not available in case of block of asset. Indexation is not available in case of slump sale. Indexation is not available in case of bond and debenture. But there are two bonds, capital index bonds and sovereign gold bonds. These are the two bonds where indexation is available under the income tax law. Apart from that, indexation is not available in first proviso to 48. Indexation is not available under 112A also. Later on, we will see in non-resident taxation also certain sections. Indexation is not available. And in case of market linked debenture and specified mutual funds also, indexation is not available. Is it clear? I hope it is clear to all of you. Coming to the next chapter, small topics are there, but very important. Taxation of demerger. What is demerger? When one entity is divided into two parts, one existing entity, one new entity. One of the division of your entity, you transfer it to a new company. that new company will be called as a resulting company, and and the existing company will be called as a demerged company. Okay, but first, before going into the provisions of the taxation, tax relaxation or tax exemptions, we need to understand the definition of demerger. So what is demerger? Demerger is defined in section 219 AA. We need to see the technical definition of demerger. Demerger means when a undertaking is transferred by a company to a resulting company as per Companies Act, and it fulfills the following condition. First, all the properties are transferred, just like amalgamation. Everything should be transferred except the miscellaneous expenses, preliminary expenses or deferred revenue expenses. In short, the fictitious assets need not be transferred. Okay. Second, all the liabilities of that undertaking should be transferred. If the liability is specific to that demerged unit, transfer that also. If the liability is general, then transfer in this ratio. What is this ratio? Suppose the company has a general liability. Some of them belongs to what? Some of them, suppose the company has a general loan. Some of the money is used by the demerged unit. Some of the money is used by the other units. Then how to segregate that and transfer in this ratio? General liability into value of asset transferred to the demerged company by in the demerger divided by the total value of the assets before the demerger. So it will be divided in the ratio of whatever assets you are transferring divided by whatever assets you have. Okay. In valuing the assets, you will not take two things. Revaluation, if it is there, if there is a revaluation of asset, ignore revaluation. And if there are any fictitious assets, ignore fictitious assets as well while taking the numerator asset as well as the denominator asset. Next, the properties and the liabilities which you will transfer, it will be recorded in the book value by the another company. But if the another company is an Ind AS compliant company, what kind of company? Ind AS compliant company, then they can follow other values also like fair value. Is it clear? What will they give us in return of what? In return of the assets which we are transferring. I am transferring my company's significant assets to you. What will you give to us? They will give us, the resulting company will give shares to our shareholder. Is it clear? The resulting company will give shares to our shareholder. Condition number 5. At least 75% of the shareholders should agree for this particular transaction, just like amalgamation. And last but not least, this demerger should also be done on a going concern basis. It is not that the unit which is getting demerged is a defunct unit or it's a closed unit. It should not be a defunct or a closed unit. It should be an existing unit. It should be working unit. It should be a going concern unit. Okay. Then comes in case of a public sector undertaking. If a public sector undertaking is doing demerger, then it is deemed to be demerger. For a public sector undertaking, all these conditions need not be fulfilled. For a public sector undertaking, the demerger is always deemed to be demerger. If a public sector company is split up into two parts, it is deemed demerger without fulfilling any of the conditions mentioned above. Okay. Now coming to the tax implication. Sir, what is the tax implication? What do you call the existing company? The existing company will be called as a demerged company. What do we call the new company? The new company will be called as the resulting company. Sir, tax implication. Let me tell you the tax implication number 1. All the assets which are transferred by, all the capital assets which are transferred by the existing company to the new company, that is resulting company, will be exempt under income tax law. Only one condition, that the resulting company should be an Indian company, just like amalgamation. Is it clear? Second condition, later on when the resulting company will sell the asset, what will be the cost in the hands of resulting company? The cost will be the cost to the previous owner, and the period of holding will be clubbed just like the amalgamation. Is it clear? Sir, what will the shareholders do? Listen carefully. This is very critical part of this particular entire chapter. The shareholders will give the old shares of the company. The shareholders will give what? The old shares of the company. For example, the paid up value of one old share. The paid up value of one old share was 10 rupees. Okay. The shareholder will return the old shares of the company. And what will they get? In return, they will get 2 shares. One, old company's reduced paid up value shares. Are you clear? Old company reduced paid up value shares and the new company's new share. Okay. So they will give the 10 rupee share and they will take say 3 rupee, 4 rupee old company shares and the new company shares. That is also what? Exempt under the income tax law. So now the shareholders have 2 set of shares. One is resulting company shares, one is demerged company shares. How will we determine the cost of acquisition of both the shares? The cost of acquisition will be segregated, will be separated, will be bifurcated between both the shares. Okay, that 10 rupee which was there now, that will be segregated between the demerged company's new share and the resulting company new shares. In what ratio, sir? Check here, please. As per section 49 2AC, the cost of acquisition of the resulting company will be determined as the cost of acquisition of the demerged company. That is 10 rupee share will be segregated in this ratio. What is this ratio? Net book value of the asset transferred in demerger divided by net worth of the company before demerger. Sir, what does net worth include? Net worth will include paid up capital and general reserves of the company only. Nothing else will be there. So whatever was the original cost of the old company share, that will be divided in this ratio. Okay. So whatever the amount will come, that will be the value of the resulting company. Sir, what will be the cost of the demerged company? The cost of the demerged company will be balancing figure. Check it, please. You have to minus from 10 rupees. Is it clear, all of you? I hope it is clear to all of you. You have to reduce it from 10 rupees. Then you will get the cost of the demerged company. Okay. Coming to another small topic. Amalgamation of cooperative banks. Okay. Amalgamation of cooperative banks, 44 DB. This section talks about 4 kind of expenses and allowances. One is section 32, which is depreciation. One is section 35D, that is your preliminary expenses amortization. 35DD, amalgamation expense, and 35DDA, VRS expenses. What will happen with these 4 expenses if there is an amalgamation of a cooperative bank? Now listen carefully. A cooperative bank can amalgamate with another cooperative bank, and a cooperative bank now can also amalgamate with another bank also. Okay. A cooperative bank can amalgamate with cooperative bank, or a cooperative bank can amalgamate and merge with what? A normal bank also, like SBI also. Both are covered over here. So in these cases, what will happen with these 4 expenses? The government says that these 4 expenses will be bifurcated and it will be segregated between the amalgamating bank and the amalgamated bank. In what ratio? From 1st April till the date prior to the date of amalgamation, amalgamating company will take, and from the date of amalgamation till 31st March, amalgamated company will take. For example, these 4 expenses. Amalgamation took place on 15th of December. Okay. So from 1st April till 14th December, amalgamating company will take 1 day prior to the date of amalgamation. And from 15th December till 31st March, who will take? Amalgamated company will take. Is it clear? This is what it is written in point number 2 and point number 3. Okay. What about the amortization in future years? In future years, obviously, it will be taken by whom? It will be taken by the amalgamated cooperative banks. Yes, because amalgamating cooperative bank is anyways closed now. In future years, it will be taken by amalgamated cooperative bank and the amalgamated bank. Okay. Now, few more things. Sir, what about the losses of the amalgamating cooperative bank? For the purpose of loss, the relaxation is not extended to banks. For the purpose of loss under 72AB, loss is only extended to cooperative bank. Listen carefully. Deduction was extended to even banks. Are you able to understand? But loss is not extended to bank. Loss will be allowed to carry forward only if the new bank, the amalgamated bank, is also a cooperative bank. Then only loss is allowed to carry forward. A very minute point. Okay. Very minute point. Therefore, if there is some loss with the amalgamating cooperative bank, it can be carried forward by the amalgamated cooperative bank, but not for another 8 years. Not for another 8 years like amalgamation of company. It can carry forward for the balance number of years. Are you able to understand or not? And last but not least, coming to the tax implication of capital gains. Amalgamating cooperative bank, whatever assets they are transferring to whom? Both. Now again, both of them are going to get exemption. Only for the purpose of losses, both of them are not getting exemption. Here, capital gain exemption also is allowed to both of them. The amalgamating company, cooperative bank, whatever assets they are transferring, all of them are exempt. To whom? To another cooperative bank or to even another bank. Both of them are exempt. Okay. What will happen with the shareholder? Tell the shareholders to do the same traditional thing. Give the shares of the old company, take the shares of the new company. Okay. Then your capital gains will be what? Exempt under the income tax law. Is it clear, all of you? So there are 3 aspects which are covered in this chapter. One is PGBP deduction. Second is losses. Third is capital gain implication. I hope it is clear to all of you. Let's come to the next discussion, which is also somewhat related to capital gains only. That's the reason we have put over here ESOP. What happens in case of ESOP? An employee joins a company. After that, the employee has to fulfill certain conditions for few years. Okay. And after that, the company will offer him an ESOP, and then eventually the ESOP will be allotted to him. Okay. So when will the ESOP get taxable? Listen carefully. ESOP will get taxable in the year in which I will get the shares. Okay. the shares are allotted to me, at that time it will be taxable. But what will be the value for taxability? The value will not be the date on which I got the shares. The value will be the date on which I exercise the option that I want an ESOP. For example, on 15th of December 2023, company offered me an ESOP. I said that yes, I want the ESOP. I exercised the option on 15th of December. That is the market value that will be relevant to determine the calculation. Okay, but it will not be taxable on 15th of December. For example, the ESOPs were actually allotted in April next year. It will be taxable in the next year, but the value will be of 15th December. Is everyone clear with this? Please tell me. The value will be the FMV of the shares on the date of exercising the option. Okay, compare with what? The purchase price. But when it will be taxable? When the shares are what? Allotted. Okay, whenever it will be allotted. This is for normal company. But if you are an employee of normal company, year of allotment, you will be liable for tax. But if you are an employee of what? Eligible startups under 80 ISC. Okay, if you are an employee of what? Eligible startups under 80 ISC, then your taxability of ESOP is deferred to the earlier of the 3 dates. Okay, which are the 3 dates? 1, 2 and 3. Okay, suppose previous year 23-24 is the year in which the ESOP is allotted to you. Okay, previous year 23-24 is which assessment year? Assessment year 24-25. Okay, so previous year 23-24, assessment year 24-25, and you are an employee of a normal company, then you have to pay tax today. Okay, is it clear? But if you are an employee of a eligible startup, then wait. Then you have to pay tax at earlier of the 3 dates. First, expiry of 48 months on the end of relevant AY. What is the relevant AY? Relevant AY is 24-25. When 48 months will expire? 48 months means 4 years will expire on 31st March 2029. Correct? On that 31st March 2029, listen. You have to add 14 days more. So the first date will come to which date? The first date will come to from the end of AY 48 months and then 14 days. That will come to 14th of April 2029. Is everyone clear with this? The second date is the date of sale of shares plus 14 days. The third date is the date on which you leave the company plus 14 days. Whichever is earliest, based on that you will be liable for tax. Okay, I hope it is clear to all of you. So later on, when the shares are sold by the shareholder, what will be the cost of the shares? The cost of the shares will be the fair market value which was taken to compute the perquisite. Is it clear? Whatever was the fair market value which was used to take the perquisite value, that will become the cost. For example, you paid 40 rupees to the company. The market value on the date of exercising the option was 100 rupees. So 60 rupees is your perquisite. Is it clear? Later on, when you will sell the shares, the cost of acquisition will become what? 100 rupees. Okay, I hope it is clear to all of you. And one last topic over here which will complete comprehensively all the provisions of capital gains which are there in your syllabus in CA final. That is taxation of buyback. What is the treatment of buyback of shares? Remember, the treatment of buyback of share is entirely in the hands of the company. Shareholder is not supposed to do anything. Whenever a company buybacks a share, whether it is an equity share or a preference shares, the company is liable to pay tax under section 115 QA at the rate of 23.296%. How did it come? It come as follows: 20% plus 12% plus 4%, 23.296% of the distributed income. What is the shareholder supposed to do? Shareholder is supposed to relax. The entire amount is exempt in the hands of the shareholder. Okay. Now, on how much amount the company is liable to pay tax? Buyback means the tax liability is on the company. The buyback amount will be on which the company is liable to pay 23.296% is as follows. Whatever amount is paid to the shareholder minus whatever amount is received on issue of shares which is determined in the prescribed manner. Okay, you have to reduce that. That differential amount will be subject to 23.296%. Now listen carefully. This point is very, very important because this will be prescribed by a rule 40BB. What does it mean, sir? Now, there are various ways of acquiring the shares, right? You can acquire the shares through an IPO. You can acquire the shares through a stock market. You can acquire the shares through a bonus share. You can acquire the shares through amalgamation or demerger or succession. Yes or no? There are various ways now. In all those cases, what will be this value? What will be this value? That is written in rule 40BB. Is it clear? Shall I start with the first one? The first one. Shares issued by the company on subscription. So if you have acquired the shares on what? on IPO. Okay, then whatever amount you have paid including the premium, that will be taken over here. Okay, I hope it is clear. Second point is not relevant as of now because that is based on dividend distribution tax, and we all know that today dividend distribution tax does not exist under the income tax law. Okay, so therefore this point is also not relevant. At one point of time it was relevant, but today this is not relevant. Third, you have acquired the shares as ESOP. How you have got the shares? As ESOP. So for that you have to take the fair market value of the shares or the amount credited to the share capital and premium, whichever is lower. Okay. Next one. Suppose you have received the shares in lieu of an amalgamation. Listen. You are a shareholder of amalgamating company. Okay. And then amalgamation happened. So you got the shares of which company? Amalgamated company. And then buyback happened. So what will you take that as value? So you will take the value of what? The amalgamating company shares. Okay. Because that is the share which you have purchased now. That is the share which you have purchased by paying the cost. So that will be the value which is taken for the purpose of determining the buyback. Okay. In case of demerger, you will take the same ratio, which I have just told you sometime before. What was the ratio to determine the demerger for? Resulting company cost and demerged company cost. That is the ratio of net book value of asset transferred divided by the net worth. Do you remember that or not? Please tell me. It is the same ratio. Okay. Next one. Next one is a very unique case. What is that unique case? Listen carefully. I have given some asset to the company. What I have given to the company? Some asset. And in return, company has given me what? Please tell me. Not money, but shares. Okay. Or the company has given me shares for settlement of some liability. Okay. So listen carefully. How I have got the shares? I have got the shares because I have sold some asset to the company. Okay. Or I have given some services to the company. Company is liable to pay me some money, and in exchange of money, they have given me shares. Okay. This is how I got the share. So how will I determine the value for rule 40BB? Then that case, your amount will be A divided by B. Sir, what is A? A is lower of the two things. FMV of the asset which you have given to the company or the liability divided by the amount credited to the share capital or security premium. Whichever is lower will become A, and B will become what? The number of shares that the company has issued you. That will give you the amount received, A divided by B. Okay. Similarly, next one is what? Next one is I have got the shares on succession of a firm. I was a firm earlier. Okay. Then I got converted into what? A company, like in 4713, etc. Okay, which we have done just some time before. So now I have become company. Now in the company, the company will give the partners what? The shares. So I have got the shares what? In exchange of my partnership firm. Okay. So in that case, how will I determine the value of the shares? A minus B divided by C. Sir, what is A? A is the value of asset. What is B? B is the value of liability. What is C? C is the number of shares. Okay. Now let me tell you what is A. A, you will take book value of all assets. Okay. But you will not take what? TDS, TCS and advance tax. Taxation you will not take. Okay. Because it is written reduced by these amount. Plus, you will not take fictitious assets. Fictitious assets will also not come in A. What is B? B means book value of all liabilities. Okay. But here also, you will not take certain liabilities like contingent liability, a liability which is not ascertained. Means what? A liability which is not final, which is not crystallized. You will not take those liabilities. And what is C? C is nothing but your number of shares issued on conversion. Next one, you have issued the shares. Company has given the shares to you as a bonus shares, and then the company has bought back the shares. What will I take the value? Bonus shares value you will take as nil. Okay. Next one, you have got the shares on conversion of preference shares or bond or debentures into equity shares. Okay. Initially you bought the bonds of the company, debentures of the company, preference shares of the company, but then the company converted that bond, debentures, preference shares into equity shares, and then the company bought back that shares. Okay. So what value will you take? You will take the same value which you have paid to the company for acquiring those instruments. You will take the same value which you have taken, which you have paid for buying those bonds, those preference shares, those debentures, those deposit certificate. Okay. Next one, the shares were acquired by you in a demat form which cannot be distinctly identified. Then you have to say the value which is first in first out basis. Okay. So suppose you have purchased 10,000 shares in lots. First 2,000, then 3,000, then 2,000, then 3,000. Company has not bought back all of them. Company has bought back only 3,000. So you have to say that the first 3,000 are bought back by the company. Okay. And the last, in any other case, you have to take what? The face value of the shares. So if you are not coming under any of the 11 cases, then your case will fall under 12th case. Okay. So this is where your capital gains topic is comprehensively revised in full English along with PGBP. So two topics we have done. The next topic which we are going to do is going to be the assessment part now. Okay. We are going to do the assessment of various entities and not assessment of various entities. We will be doing return filing, assessment procedure, income escaping assessment, so on and so forth. We will be trying to do all those things in the next few lectures. Okay. Till then, take care all of you. Bye all of you.